To me, the wild card next year is China. And to me, the great question is do we underestimate China once again? And the export-import dynamic of America adds to GDP. Is that possible?
I think trade could be a bit of a boost next year. I don't think it'll be dramatically so. I think there's two things to think about. One is, are we going to end up with across-the-board import tariffs in 2025? Is that a real issue, depending on how the political cycle plays out? And then the second thing is, everybody's talking about reshoring, but there's not really that much signs of it yet. So we're not really, we're still importing disinflation. It's not as if we're all of a sudden manufacturing all of these goods here, and that's going to create lots of goods inflation in the U.S.
Who do you think is more right? The Fed projecting out 3 rate cuts next year, or the market pricing out 6 rate cuts next year?
The Fed. Unless we get a recession, which is not my base case.
So in other words, that seems the most likely, which is actually less than the market is currently expecting and less sort of disinflationary than people are pricing in.
Yeah, but I think the one thing is the market's not pricing the Fed getting all the way down to somewhere around 2.5% to 3%, which is where I think the Fed will ultimately cut to. So that's where the rest of the market could sort of price to.
We have to turn to Frankfurt. Thank you so much. Stephanie Roth with us. Just terrific summary here with Wolf Research Publishing, and that we can get that research from Wolf. Lisa, this is the perfect time. We are so fortunate, given the head-spinning blur of Fed, Bank of England, ECB, to have with us Michael McKee. He's in Washington still, I believe, and joins us now as we go to Christine Lagarde. Mike, I made fun of it yesterday. I literally had goosebumps over what was going on in your press conference. To me, it's almost historic times. Let's start with a why. Why are we seeing this with Powell, Bailey, and Lagarde in minutes?
Well, I think what's basically happening is we're seeing inflation fall faster in the United States than other places, lower already in Europe. So the central banks are acknowledging that inflation is coming down and that their monetary policies have worked. And there really doesn't seem to be a reason at this point to raise rates further.
On consumption elasticity, if we see the 30-year mortgage rate come in, if we see the money market rate come in, the dynamics of the inflation surge that we saw, does that lead Mike McKee to predicting some form of roaring 2020s, as Ed Yardeni talks about?
I don't think that's what's lined up here. We may see inflation rise at the beginning of the year because of base effects from low inflation a year ago. But the way people are spending, we're seeing solid but small gains, not the kind of outsized gains that we saw earlier this year. And part of that was inflation driven, and part of it was the hangover from the pandemic. But right now we're beginning to see people getting back into more normal 2019 kind of spending patterns. The retail sales this month, everything was pretty much as you'd expect, with gasoline prices pushing things down. But clothing stores were buying up clothing and toys and sporting goods.
And Lisa, imagine
what the holiday season.
Imagine what refrigerators did.
Ha ha ha.
But it's out there. I think there's been a complete underestimation of the resiliency of the American consumer. That's the heart of the matter.
I bought a refrigerator, and he will never let me live it down. I am wondering, Mike, when we talk about a Federal Reserve and how much they have changed their tone, how much this is just a reversion back to transitory without saying the T word.
It is basically a recognition that transitory was correct. It was just long transitory instead of long COVID. The things that the Fed thought would happen right after the pandemic are finally happening now, where labor and the overall goods supplies are coming back into balance. And that's bringing down inflation at this point. That's what really pushed it up now. When you look back, we have a much clearer picture of what happened.
We still have with us Stephanie Roth, chief economist at Wolf Research, who I saw vigorously nodding her head when I talked about transitory. And I'm just wondering, are people going to look back on transitory as actually the right call, just too early?
I kind of think so. I think it was just a timing thing. And now COVID's getting out of the economy, and the economy's more back to normal. And we're back to kind of the old economy where inflation is running at 2% and the economy can just hum along.
Mike McKee, one more question as we go to Christine Lagarde and the challenges of Europe. I look at the R-starred debate. Does Europe have an R-starred, and is it just set lower, lower, lower than America?
Well, they do, and the New York Fed calculates that as well. But basically what the situation is there is their potential growth rate is lower. Their productivity is lower. So our star is going to be lower there. They also have a demographic that skews older than the United States. So the problem for both the U.S. and the ECB is, where do you think that R star is? Where is that neutral rate? And it seems to have been higher, but will it come down as the economy grows, but at a more slow pace?
Stephanie Roth, Michael McKee, thank you so much. Lisa, we're waiting here for the ECB. They do it differently than the press. She does not walk into the press conference, and they do have follow-up questions, I think. But it's going to be as original. We know now it's going to be as original as the shock that we saw yesterday.
What I find fascinating is the market's just not buying what the ECB is selling. The ECB came out and said that they basically were going to be, completely keep rates high. They were determined to bring inflation lower. And the market says, yeah, right, we still think you're going to cut before the Federal Reserve. And to me, that is notable at a time when you have a real different tone. And really, you don't hear ECB Christine Lagarde following along with Jay Powell.
We're going into this at 8:45 Wall Street time, and we're doing it with a bid to the market. Russell 2000 up almost 2%, which shocks me. That's a real follow-on. Continuing bid, futures up 22 on the Standard & Poor's. And critically, the 10-year inflation-adjusted real yield in the United States, it went up off retail sales, a higher real yield, and now it's come back down to 1.75%. A break there to 1.73 would be noteworthy. They do this differently in Europe. They line up with the photographers with 3 podia, as they always do. Wolfgang Prussel, among other worthies, with Christine Lagarde. She is a president of an ECB, and there will be a statement, Lisa, and then there will be Q&A.
Which will be really interesting this time around. Will she hold the line on sufficiently restrictive for a prolonged period of time until we get inflation under control, or will she say inflation is coming down and, maybe we can cut rates too?
The distinction here is 5-ish% in Europe versus 2-3-ish% maybe in America. As we set up now, we bring you worldwide on Bloomberg Radio and Television the president of the ECB. Here is Christine Lagarde.
Good afternoon and welcome to our press conference. On stage, there's President Christine Lagarde and Vice President Luis de Guindos. My name is Wolfgang Prussel. I also welcome the participants that are online. If you take your questions, please turn on your cameras and your microphone. And with that, I would like to hand over to President Lagarde, please.
Thank you very much, Wolfgang. And I'm going to preface the reading of the monetary policy statement with asking for your indulgence. I'm in COVID recovery mode. I would not have wanted to miss this last press conference of the year with you, nor did I want to miss the Governing Council meeting of yesterday and today. But it may come a point where I start coughing my life out. And at that point, my Vice President, dear Luis, has agreed that he will just take over. As simple as that. But I'm not contagious, rest assured. It's just acute bronchitis. So, good afternoon. The Vice President and I welcome all of you to our press conference. The Governing Council today decided to keep the 3 key ECB interest rates unchanged. While inflation has dropped in recent months, it is likely to pick up again temporarily in the near term. According to the latest Eurosystem staff projections for the euro area, inflation is expected to decline gradually over the course of next year before approaching our 2% target in 2025. Overall, staff expects headline inflation to average 5.4% in 23, 2.7% in 24, 2.1% in 25, and 1.9% in 26. Compared with the September staff projections, this amounts to a downward revision for 23 and especially for 24. Underlying inflation has eased further, but domestic price pressures remain elevated, primarily owing to strong growth in unit labor costs. Eurosystem staff expect inflation, excluding energy and food, to average 5% in 23, 2.7% in 24, 2.3% in 25, and 2.1% in 26. Our past interest rate increases continue to be transmitted forcefully to the economy. Tighter financing conditions are dampening demand, and this is helping to push down inflation. Eurosystem staff expect economic growth to remain subdued in the near term. Beyond that, the economy is expected to recover because of rising real income, as people benefit from falling inflation and growing wages, and improving foreign demand. Eurosystem staff therefore see growth picking up from an average of 0.6% for 23 to 0.8% for 24 and to 1.5% for both 25 and 26. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. Based on our current assessment, we consider that the key ECB interest rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to this goal. Our future decisions will ensure that our policy rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The key ECB interest rates are our primary tool for setting the monetary policy stance. We also decided today to advance the normalization of the Eurosystem's balance sheet. The Governing Council intends to continue to reinvest in full the principal payments from maturing securities purchased under the Pandemic Emergency Purchase Programme during the first half of 2024. Over the second half of the year, it intends to reduce the PEP portfolio by 7.5 billion euros per month on average. The Governing Council intends to discontinue reinvestment under the PEP at the end of 2024. The decisions taken today are set out in a press release available on our website. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So turning to the economic activity. The euro area economy contracted slightly in the third quarter, mostly owing to a decline in inventories. Tighter financing conditions are subdued foreign demand are likely to continue weighing on economic activity in the near term. Prospects are especially weak for construction and manufacturing, the two sectors most affected by higher interest rates. Services activity is also set to soften in the coming months. This is due to spillovers from weaker industrial activity, fading effects from the reopening of the economy, and the broadening impact of tighter financing conditions. The labor market continues to support the economy. The unemployment rate stood at 6.5% in October, and employment grew by 0.2% over the third quarter. At the same time, the weaker economy is dampening the demand for workers, with firms advertising fewer vacancies in recent months. Moreover, even though more people are in work, the total number of hours worked edged down by 0.1% in the third quarter. As the energy crisis fades, governments should continue to roll back the related support measures. This is essential to avoid driving up medium-term inflationary pressures, which would otherwise call for even tighter monetary policy. Fiscal policies should be designed to make our economy more productive and to gradually bring down high public debt. Structural reforms and investments to enhance the euro area's supply capacity, which would be supported by the full implementation of the Next Generation EU programme. To that end, it is important to swiftly agree on the reform of the EU's economic governance framework. Moreover, it is imperative that progress towards capital markets union and the completion of the banking union be accelerated. So let's look at inflation. Inflation dropped over the past 2 months, falling to an annual rate of 2.4% in November, according to Eurostat flash release. This decline was broad-based. Energy price inflation fell further, and food price inflation also came down, despite remaining relatively high overall. This month, December, inflation is likely to pick up on account of an upward base effect for the cost of energy. In 2024, we expect inflation to decline more slowly because of further upward base effects and the phasing out of past fiscal measures aimed at limiting the repercussions of the energy price shock. Inflation excluding energy and food dropped by almost a full percentage point over the past 2 months, falling to 3.6% in November. This reflects improving supply conditions, the fading effects of the past energy shock, and the impact of tighter monetary policy on demand and on the pricing power of firms. The inflation rates for goods and services fell respectively to 2.9% and 4%. All measures of underlying inflation declined in October, but domestic price pressures remained elevated, chiefly because of strong wage growth, together with falling productivity. Measures of longer-term inflation expectations mostly stand around 2%, with some market-based indicators of inflation compensation declining from elevated levels. So what's our risk assessment? The risks to economic growth remain tilted to the downside. Growth could be lower if the effects of monetary policy turn out stronger than expected. A weaker world economy or a further slowdown in global trade would also weigh on euro area growth. Russia's unjustified war against Ukraine and the tragic conflict in the Middle East are key sources of geopolitical risk. This may result in firms and households becoming less confident about the future. Growth could be higher if rising real incomes raise spending by more than anticipated, or the world economy grows more strongly than expected. Upside risks to inflation include the heightened geopolitical tensions, which could raise energy prices in the near term, and extreme weather events, which could drive up food prices. Inflation could also turn out higher than anticipated if inflation expectations were to move above our target, or if wages or profit margins increased by more than expected. By contrast, inflation may surprise on the downside if monetary policy dampens demand by more than expected of the economic environment in the rest of the world, and in the rest of the world worsens unexpectedly, potentially owing in part to the recent rise in geopolitical risks. So let's now turn to the financial and monetary conditions. Market interest rates have fallen markedly since our last meeting and lie below the rates embedded sorry. I'll start again. Market interest rates have fallen markedly since our last meeting and lie below the rates embedded in the staff projections. Our restrictive monetary policy continues to transmit strongly into broader financing conditions. Lending rates rose again in October to 5.3% for business loans and 3.9% for mortgages. Higher borrowing rates, subdued loan demand, and tighter loan supply have further weakened credit dynamics. Loan to firms declined at an annual rate of 0.3% in October, and loans to households also remained subdued, growing at an annual rate of 0.6%. With weaker lending and the reduction in the Eurosystem balance sheet, broad money, as measured by M3, has continued to contract. In October, it fell at an annual rate of 1%. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks have demonstrated their resilience. They have high capital ratios and have become significantly more profitable over the past year. But the financial stability outlook remains fragile in the current environment of tightening financing conditions, weak growth, and geopolitical tensions. In particular, the situation could worsen if banks' funding costs were to increase by more than expected, and if more borrowers were to struggle to repay their loans. At the same time, the overall impact of such a scenario on the economy should be contained if financial markets react in an orderly fashion. Macroprudential policy remains the first line of defense against the buildup of financial vulnerabilities, and the measures in place contribute to preserving the financial system's resilience. So, in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. Based on our current assessment, we consider that rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary to ensure such a timely return. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restrictions. The Governing Council intends to reduce the PEP portfolio over the second half of 2024 and to discontinue its reinvestment under the PEP at the end of 2024. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. Now ready to take your questions. Thank you.
Thank you, President Lagarde. And the first question goes to Annette Weisbach of CNBC. Annette, please.
Wait. Get my papers in order.
Thank you very much. I have obviously two questions. The first one is on the market expectations about the future rate trajectory, especially after the Fed yesterday was quite explicit about the potential of 3 rate cuts during the course of next year. So what's the ECB's thinking? And then the second is on the PEP. Is the PEP a prerequisite, or the earlier stop of reinvestments or fading out of reinvestments, is that a prerequisite for having rate cuts? And does that make them also likely to start in March? Thank you.
Thank you very much for your two questions. But let me remind you one thing. We are data dependent. We are not time dependent. We are data dependent. And let me take you into the Governing Council room. As you remember, we have defined the 3 key criteria of our monetary policy stance, namely inflation outlook, underlying inflation, transmission, strength of the transmission of our monetary policy. And it is against those 3 criteria that we determine whether enough progress has been made and whether our monetary policy is working. And clearly, when we look at our inflation outlook, we look at the projections produced by staff and the entire Eurosystem on the occasion of the December meeting. Our new projections see inflation at 2.1% in 2025, not 2026, which is included, but 2025 we see headline at 2.1, and the path to get there is flatter than it was before, which lower the risks of inflation expectations risking de-anchoring. That's on inflation outlook. On underlying inflation, it says quite specifically in the monetary policy statement that a lot of indicators are showing that underlying inflation comes below expectation, with a decline across all components. And when we look at transmission, we are clearly seeing a strong transmission to the financing of the economy and strong transmission at large, particularly if we look at the volume of loans to both corporates and households. So, should we lower our guard? We ask ourselves that question. No, we should absolutely not lower our guard, and I'll give you 2 good reasons for that. The first one is that our inflation outlook, which is one of the 3 criteria, is conditioned on the interest rate path that was embedded in market data at the time when our cutoff date was determined. Cutoff date, as you will see in the publication, was November 23rd. So that's point number 1. Point number 2, when we look at all the measurements of underlying inflations, there is one particular measurement which is hardly budging. It's declining a little bit, but not much, and that is domestic inflation. And domestic inflation is largely predicated by wage. So we need more data. We need to understand better what happens there, and why is domestic inflation resisting. To understand that, we need a category of things. Number 1, we need wage data, and that is going to be measured in multiple ways. We have really as wide an area of indicators for that: the wage tracker, the number of job offers, the vacancies, the turnaround, plenty of them. And that, of course, determines how tight is the market, and therefore how wage will behave in the next few months. And when we look at the data that we have now, it is not declining. Compensation per employee has declined from Q3 to Q2. That's true. But the other indicators, no. So we need to have a lot more data in that regard. And the second element, which is critical, given the way we have constructed our projections, the way staff has constructed projections, we need more information about profit unit as well. Because our projection is predicated on the assumption that a lot of the catch-up wage growth will actually be absorbed in the markup of enterprises and corporates. So we need to have these two on a more sustainable basis, demonstrating that domestic inflation too is going to head down towards our target. We don't have that yet. We will have a lot more data in the course of 24. It will be particularly rich in the first half, but we will need that in order to determine whether it is actually sustainable or not. Now, you had a second question, which had to do with PEP. Let me just tell you how I regard the decision that we made on PEP, and that was shared by a very, very large majority of the governors. Everybody was fine with stopping the reinvestment at the end of 24. Some would have liked a slightly different tapering, starting a little earlier, starting later. So we ended up with that 100% reimbursement until the end of June, 50% reinvestment from July until the end of December, no reinvestment from January onwards. This is really balance sheet normalization. It's a good moment to do that. We have little by way of fragmentation. Markets have absorbed our decline in APP reinvestment as we had done it in a very similar fashion. So we think that it's really it's really on a standalone basis, and it will continue to operate on the back burner, if you will, without, we hope, being significant. And that's how we came to that decision. But it's totally unrelated to, oh, if they do that with PEP, then maybe they're planning on this on rates. No. Rates are the primary tool, and we're going to use that independently of what happens on the PEP side, which, as I said, is on the back burner.
Thank you, President Lagarde. And the next question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon. Thanks for taking my questions. First question relates to the discussion. Last night, Jay Powell said that in their discussion, rate cuts have started to come into view, and we're definitely a part of the discussion. The question I have is the same true for the ECB? Was there any discussion from anybody about rate cuts at some point and how it could be done? The second question is related to what you said a few weeks ago. You said you don't expect rate change for a couple of quarters ahead. Today, do you maintain that view, or do you think data since then has evolved to a point where you would no longer keep that view?
Thank you very much for your two questions. On the first one, it's very easy. We did not discuss rate cuts at all. No discussion, no debate on this issue. And I think everybody in the room takes the view that between hike and cut, there's a whole plateau, whole beach of hold. You know, it's like, I don't know, solid, liquid, gas. You don't go from solid to gas without going through the liquid phase. So this was just not discussed. I think going forward, we are going to continue to be data dependent. We are going to continue to determine meeting by meeting what we see on a totality of data. But obviously, given a certain resistance of domestic inflation and the risk of second round effect that we absolutely want to avoid, we're going to be very attentive to that category of data that I have just described.
Thank you, President Lagarde. Jana Rando from Bloomberg. Jana, please.
Good afternoon. I have to come back to the rate outlook. You mentioned that a lot of data will arrive in the course of the first half on how wages and inflation will develop, and by coincidence, PEP reinvestments will also slow right around that time. So I would be interested in your view on whether that seems like a reasonable point in time to change your view on what kind of policy path for interest rates is needed, and whether that would be a good moment to consider rate cuts. And the second question I have is on something you mentioned in your introductory statement. You said governments should rein in fiscal support, or otherwise monetary policy might need to be tighter. Do you have any particular country in mind with that? Thank you.
On your latter question, we don't have any particular country in mind. I think we have the principle in mind that the fiscal support, particularly the discretionary support that was granted to compensate for the high prices of energy, that should absolutely be withdrawn. When you look at how fast the price of energy has gone down, both on the oil and gas front, it's just totally unjustified and probably unjustifiable to continue to have those fiscal measures in place. But no identification of any particular country. I think we make the point in that same paragraph, if I just go back to it, that we strongly encourage the reduction of the sovereign debt, but I'm sure you will find that reference. Let's see. Anyway, we make the point that fiscal measures must be rolled back, that sovereign debt must be reduced, and we make another point, which, as you will have noted, because you're a regular of this monetary policy statement, we have changed the language on structural reforms, and we have done that because we perceive and we fear a level of procrastination in reaching agreement, in closing on some of the technical files which have been pending for way too long, and which would be critical in order to support the competitiveness of the euro area. You will see when we publish the data that competitiveness is really weakening, and whether it's capital markets union, whether it's banking union, or the whole market union and free movement of goods and services, a lot of progress needs to be made, and that point was made very clearly. The Vice President is a very strong supporter of that, and there were many voices on the Governing Council to say, in the presence of Valdis Dombrovskis, who is working on those issues, that it has to happen. On your first question. It is true that we will receive a lot of data in the first half of 24. So it will be data rich, particularly on the employment front. Just consider that there are about 50% of the employees that we cover under our wage tracker who will see their collective agreement renegotiated, and new terms of employment and possibly new wages will be agreed. And in the same vein, in the corporate world, whether it's for goods or services, terms and conditions, price lists are often revised also in the first few months of any calendar year. But it's not to say that this will be it. we will remain attentive to a whole host of data that will come in the course of 24. Thank you.
The next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you very much. I have two questions, President Lagarde. Firstly, if I could just ask you about comments that Fed Chair Jay Powell made yesterday evening. He said that there was the risk that they would hang on too long with rates at the current level. And he said they were very focused on not making that mistake of holding on too long at a high level. Do you share that concern? And secondly, if I could ask about market expectations and market pricing in a slightly different way. Do you think that the current market pricing, which is for the ECB to cut rates 6 times next year, starting from March, is that reasonable? Does that seem fair to you? Thank you.
Thank you, Martin. On your first question, who wants to hang on for too long? But equally, what we are saying today on the basis of the forecast that we have produced by the Eurosystem staff, we don't think that it's time to lower our guard. And we believe that there is still work to be done, and that can very much take the form of holding. And I think in our monetary policy statement, we refer specifically to sentences that they don't have a particular magical virtue, but now of course I find the fiscal comment that I wanted to refer to. So essentially what we say, and we have said that before, and we are repeating that same sentence, we say, based on our current assessment, we consider that the key ECB interest rates are at level that, maintained for a sufficiently long duration, will make a substantial contribution to our goal. And we continue with our future decisions will ensure that our policy rates will be set at sufficiently restrictive level for as long as necessary. If you combine that with our data dependency and the fact that we are not, narrowing the focus or the focal of what we look at, but we know that some data and a combination of data and the mechanics between these two, wages and profit in particular, are going to play a significant role, and we will be particularly attentive to those. But there will be, more data coming in. We will have another bank lending survey. We will have, a corporate telephone survey coming in. We will take that into account to determine, when we can lower the guard, for sure. But that's where we are at the moment. Now, your second question, of course, I'm not going to address it directly. I will simply say that we will be looking at our 3 criteria. We will be identifying whether, on the basis of staff forecast, on the basis of our measurements of underlying inflation, on the basis of our strong transmission of monetary policy, we are at this medium-term target that we have set for ourselves of reaching the 2% target at the end of our projection. We are probably a little bit more severe with ourselves because the end of our projection, or the end of the projection horizon, would take us to 2026, where we have 1.9. We are going to probably look very carefully at the end of 25, and I think end of 25 we're at 2.1. And we arrive on a more sort of sliding basis to that 2.1%. That's what we are going to be doing. And, as I said, the projections that we have now is conditioned on the interest rate path that was embedded in market data before the cutoff date. That cutoff date was November 23rd.
President Lagarde. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you. Good afternoon. Thank you for the opportunity. My first question is on some countries entering a recession and seeing the projections with growth picking up. But how much the risk of recession, of things getting worse, comes into your decisions today and on interest rates? And then on PEP, I have a question because you said in the past that flexibility in PEP reinvestments is the first line of defense against fragmentation risk. And you said before it's a good moment. This sounds big news that fragmentation risk is not a worry. But can you say a bit more about this? Thank you.
Well, first of all, let me say that we do not have a recession in our baseline. And of course, I'm not looking at specific countries. I'm looking, and we are looking collectively at the euro area at large. Our mandate is not to cause a recession. Our mandate is to reach the medium-term target of 2%, which we've defined as price stability. And to do that, we know that we're going to have to continue with financing that will be triggered by the interest rates that we set. That financing will necessarily dampen demand. We are seeing it. So we take all the macroeconomic data and the whole situation into account, but we are driven by delivering on our mandate. So on PEP, first of all, don't forget that as long as we reinvest, so meaning 100% of redemption coming to maturity, as long as we reinvest, we still have that flexibility. It was one of the attributes of PEP. And that flexibility applies to the 100% reinvestment until the end of June, and then to 50% of the reinvestment until the end of the calendar year 24. We believe that PEP has served its purpose. It was intended for the pandemic. It was an emergency program. Despite stupid COVID that comes to hit you now and again, as it did hit me, pandemic is over. The WHO has declared so. The emergency is no longer around. And obviously, it's a normalization of the balance sheet that is welcome at a time when we don't see actually currently risk of fragmentation. But if there were such risks, we also have tools that are available that we would not hesitate to use for a second. Because proper transmission is actually part of the mission.
Thank you, President Lagarde. And the last question today goes to Kolja Rozio with Die Zeit on digitally. So Kolja, please turn on your microphone and your question, please.
Okay, thank you very much for the opportunity to ask my two questions. First question is, the German government has just passed some kind of savings package that includes a higher carbon tax, for example. And to what extent will this affect inflation in the Eurozone? And the second question is, if I understood you right, the main driver for the relatively stubborn inflation in the coming month will be wages and profits. Does this mean that there's still some risk, some kind of risk for some kind of wage price spiral, or is it something else? Thank you.
Thank you very much. On your first question, it's obviously premature. The German coalition announced decision came yesterday. We have not figured those numbers and their forecast into our current projection. And obviously we will do so, and we will try to understand exactly what impact it would have. Germany is a big country. It represents roughly 25% of the euro area, and fiscal measures that would be taken, need to be accounted for, and their impact on inflation determined. So we will do that. Thank you for finishing with the wage and profit question, because it's something that staff, both here at the ECB, but also in the National Central Bank, looks at very, very carefully. And what we have seen is a contribution from profit unit to inflation declining over the course of 23. On memories, the contribution was about 2.4. and it's now down to 1.4%. If that is confirmed, but it's a big if, and we need to really understand and make sure that this is sustainable. But if that is confirmed, it would mean that the hypotheticals that we had in our previous forecast and that we have for this forecast in December, which was that markups would be reduced in order to absorb increased wages by way of catch-up or otherwise, that is actually taking place, which would be really good news for inflation purposes. But we don't have enough on the table to really determine that this is what is going to happen. We will. Thank you very much. And if that was the last question, let me just wish all of you happy holidays, be safe, look after yourself and your families, stay warm, and be happy. Thank you.
Thank you very much. And the next press
ECB President Christine Lagarde wrapping up the news conference in Frankfurt, Germany, clearly under the weather, and we wish her all the best. If yesterday was about Santa and a Santa rally, today was about the Grinch. This market, completely different in Europe compared to what's taking place in the United States. In the United States, a Chairman Powell-inspired rally for a sixth day on the S&P 500, up 0.5%. It's not what you heard from Lagarde today. That's not important. It's what you didn't hear. This was not a repeat of Chairman Powell. The ECB is moving at its own speed, and it is not ready to discuss easing policy. Take a listen to what Christine Lagarde had to say.
No. We should absolutely not lower guard. When we look at all the measurements of underlying inflations, there is one particular measurement which is hardly budging. It's declining a little bit, but not much. And that is domestic inflation. We need more data. We need to understand better what happens there. And why is domestic inflation resisting?
Let's get straight over to Frankfurt, Germany, with Bloomberg's Maria Tadeo. Maria, this was not Chairman Powell, Volume 2.
No, it was not. And Jonathan, you and I talked about this when the statement hit about 2 hours ago, and we said there's nothing in it that would suggest this is a European Central Bank that wants to match the Fed in any way. And I think when you look at that press conference, it's double clear that was not the intention. The head of the ECB made it very clear they had not debated internally the idea of cuts. It was not a topic that was up for discussion at all. That was a quote. She also said this is a central bank that is data dependent. Again, that is a reference to this idea that it cannot follow the Fed. It looks at its own data, and to me it was also very clear from the language that she used that they want to stretch the theme of higher for longer for as long as possible. Remember, she said you don't go from hiking to cutting. There is life in between. The question is for how long can you credibly maintain that higher for longer narrative. But again, the bottom line is that if you were hoping for any clues or any pivot that would look like the Fed, well, you didn't get that in this press conference. This was a Christine Lagarde that made it clear no cuts have been debated. And in the meantime, the European Central Bank will look at data, especially at the start of the year. Remember, she talked about a bulk of new data they're expecting and the cut of data, the forecast for this month, that would assess the future steps forward. No mention of cuts. And again, this idea that higher policy is sufficiently restrictive. They really want to milk this higher for longer theme for as long as they possibly can.
Hey, Maria, great update, great roundup. throughout this morning. We're today there in Frankfurt, Germany, at ECB HQ. Here stateside in New York, about 4 minutes into the session, the rally advances another 0.6%. We add some more weight to this big move on the Nasdaq, up another 0.7%, and the Russell of small caps have been absolutely flying. To discuss, Invesco's Alessio De Longis, Winnie Caesar of Credit Sites. Winnie, in some ways, that was some pushback from President Lagarde. How credible was that pushback?
We think it was pretty credible, and we have long expected that the Fed is going to be cutting rates before the ECB because there are structural issues within the European and the UK economies that are likely to leave inflation higher than in the US, even as those economies slow a bit more than what we were expecting. And so we do think that the ECB is going to need to be quite hawkish, or at least more hawkish than what at least the market was pricing in for an extended period of time versus the Fed, which does have a little bit more of that ability to shift to real policy rates, keeping things in restrictive territory, but not necessarily incrementally tightening policy.
Let's get straight to the market moves. Big moves again this morning, up another 2.7% on the Russell. The small caps absolutely flying. In the bond market, the rally continues. In the Treasury market, the gains fade a touch, but still stick. Yields are lower at the front end by 5 basis points, 4.38. Alessio, you've been overweight, constructive on risk throughout the whole of this year. What's changed for you in the last 24 hours?
Well, thank you for the note, John. Yes, especially since the early summer, we've been positioning with high conviction for this Goldilocks type of scenario, falling inflation, improving growth, albeit low growth, but improving growth and stable unemployment. What has changed? Well, we simply got validated by the economic data and most importantly by policymakers, by central banks. So what's changing is the pricing, right? November was an impressive rally for risk assets, both in absolute and relative terms to safer asset classes. December is on course to repeat that. I would say that where we see more room to run is exactly the trade that or the assets that you highlighted. Smaller capitalization stocks, mid caps, small caps, value-oriented sectors. There is so much room to close the gap relative to high quality mega cap tech, especially in the US. Where that rotation, I think, still has room to run, both from a cyclical perspective and from a valuation perspective.
A dose of decent data this morning as well. Let's get the roundup, the update from Mike McKee. Morning, Mike.
Good morning, John. Well, it was good news overall for the markets because the American consumer is still spending. Retail sales come in up 0.3 more than anticipated and making up for a decline, revised decline in the month of October. Retail sales control also up strongly, suggesting that people are out spending for their holiday purchases. Excuse me. Jobless claims come in at 202, much lower than anticipated, but this is the time of year when those get distorted, but the message is still the same. The labor market is okay, and our latest inflation indicator, import prices, shows a decline. So where does this leave us? Well, the market is not wrong in thinking the Fed is going to be cutting rates. The question is, are they going to be wrong in how much rates get cut and how fast? Take a look at the second column from the left there, which is 2024. And you can see while they lowered their forecast by about 75 basis points for next year, the dispersion among the members of the committee is still pretty wide. They aren't sure exactly what they're going to do or when they're going to do it. And though we paid a lot of attention to what was going on in 25 and 26, the dispersion there even wider. And you notice there is one person at the top of each of those years who doesn't think rates are going to really come down at all. We don't know who that is, but that's going to be a fun guessing game for the markets going forward. Finally, we'll take a look at where we are with Fed funds futures. It's a very neat picture, shows continual decline. And up through January of 2025, the market now thinks you're going to get 7 rate cuts. That might be a little aggressive, but as a lot of analysts said this morning, the market tends to overreact and it may come back some. But at this point, the idea that rates will be cut and relatively soon has legs.
We're looking at the prospect of all-time highs at a close on the Nasdaq. Mike McKee, thank you. I want to talk about 2 completely different people with apparently 2 very different views. And I'm not talking about Lagarde and Powell. I'm talking about Powell and Powell. Chairman Powell, December 1. It would be premature to speculate on when policy might ease. 12 days later, same chairman different man apparently. The question of when it will become appropriate to begin dialing back the amount of policy restraint in place is clearly a topic of discussion now in the world, and also a discussion for us at our meeting. So Winnie Caesar, I would ask you, what's changed in 12 days for this Fed chair?
Well, I would ask the same question because we were very surprised by the dovish tone that Powell struck at this press conference yesterday. We had anticipated a Fed that was going to remain in quite hawkish messaging up until the very day that they actually cut rates. So to kind of preview the discussion came as a surprise to us because I think that the last thing the Fed wants to do is loosen up financial conditions really materially ahead of a rate cut and potentially bring another round of inflation. But perhaps the way that the Fed is now viewing things is that sitting in overly restrictive territory for an extended period of time presents a greater risk than the potential risk of a stagflation type scenario.
Alessio, what was it for you? What was behind the change?
Well, maybe we had a few data points, particularly inflation, both the surveys and actual inflation data points that did surprise to the downside, both in the US and globally. And we know in real time what commodity prices are doing. And oil prices, energy prices have fallen by 20% in the last 2 months cumulative. And central bankers know mark to market in real time how that will feed directionally into their forecast or future actual inflation prints. So one version, one theory, one answer to your question could be a U-turn based on this mark to market on the economic data that gave them more confidence. Or maybe we should be worried about this type of U-turn and be suspicious that Chair Powell, as well as the ECB, may actually rebalance their language over the next few weeks. Maybe that's the lesson to be learned here. Let's not extrapolate too far.
We've reset the bar quite high. Winnie, overweight investment grade and high yield for you going into year end and into 2024. Do you worry about how quickly we've reset the bar?
I do worry about how quickly we've reset the bar, especially as in January we'll have conversations around another government shutdown, U.S. budget, the fiscal side of things. All of those topics are probably going to result in a little bit of a bout of risk off. We have a lot of technicals on the seasonal side of things that would drive us to expect a pretty positive December. And that's not, coming as a particularly big surprise. But looking ahead into 2024, it's not going to be a straight line to our year-end spread targets. We might get there and then give something up. And we are identifying these different pockets of volatility and kind of the mid-January timeframe as investors come back from the holiday season and realize, man, we have a long way to go before the Fed actually even starts cutting rates. It's definitely going to be an interesting time.
You can't help but laugh. We're hitting year-end price targets for next year, this year, before getting to the end of 2023. Alessio, I'm looking at America. I'm looking at a market through 4,700. Goldman have got a 4,700 price target for year-end next year, by the way, already there. I've got no idea what happens in the next 12 months, but I can sum up the last 24 hours. We've got decent data, retail sales, jobless claims. I've just heard from a Fed chair who's ready to talk about cutting interest rates, maybe as soon as March, based on the indications we got at the news conference yesterday. And Alessio, I'm starting to think about where I want to be geographically, which regions I want to place money, move away from money market funds. Alessio, why on earth would I want to go to Europe right now, given what I just heard in that news conference?
Well, it's a very good point, because if there is one element that has changed with the combination of the last two press conferences, that we have clearly opened the possibility for a dollar weakening cycle to set at the beginning of 2024. With the ECB lagging behind the Fed in terms of interest rate cuts, at least from their intentions, I would say that the ECB is in a very comfortable position, because if the Fed does deliver cuts in front of it, will ease financial conditions for the ECB without the ECB doing anything and maintaining a yield differential in favor of the euro. So a dollar downtrend would contribute to that argument in favor of equities outside of the US, particularly Europe. And I will add one more thing. We talked earlier about the implications of a Goldilocks scenario for cyclical stocks, cyclical sectors, and cyclical styles. That is a highly supportive environment for European stocks that screen much more on the smaller capitalization characteristics and value-oriented characteristics relative to quality of mega cap tech in the US. So that would be my case for going to Europe, both from a currency perspective, from a cyclical perspective, and evaluation perspective. I think it can be the biggest surprise of 2024.
Alessio, we've had many surprises through 2023 already. Alessio, Winnie, to the two of you, thank you. Have a wonderful Christmas, and thanks for catching up with us as we leave behind the last ECB rate decision of the year and the last decision for the Federal Reserve as well. 14 minutes into the session, we had some more weight to this monster rally of the last couple of months. On the S&P 500, up by 0.6%. On the NASDAQ, up by 0.75% on the composite, 0.5% on the NASDAQ 100. The Russell, the standout winner here, the small caps higher by 3 percentage points. Coming up on this program, House Republicans authorizing an impeachment inquiry into President Biden.
House Republicans who have been really pushing this impeachment without any evidence, like without doing this political stunt. I mean, that's what they've been doing over and over again.
This as new polling shows Donald Trump taking the lead across all 7 swing states. That conversation up next.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
House Republicans who have been really pushing
pushing this impeachment without any evidence, like without doing this political stunt. I mean, that's what they've been doing over and over again.
I think we've made our point very clear today. Evidence uncovered has shown a very disturbing trend by the Biden family. We've spent months in this investigation accumulating evidence.
It's a tough morning for the sitting president. GOP lawmakers voting to escalate an impeachment inquiry into President Biden. The president pushing back, saying, quote, instead of doing their job on the urgent work that needs to be done, they're choosing to waste time on this baseless political stunt. This is the latest Bloomberg Morning Consult poll, shows Trump pulling ahead in Michigan, with Biden losing support from key demographics. Your team coverage begins right now. AMH here in New York, Katie Lyons in D.C. Anne-Marie, another tough poll.
This is a tough poll, and for our poll, alongside with Morning Consult, this is our third survey, and what we found is that Trump was able to flip Michigan in this poll. We haven't seen that before. So Biden is now losing in all of these key swing states, and the issue is he's losing support for some key demographics in his own party that voted for him. I'm thinking about Black Americans, also women. The support has gone soft for him there, as well as young voters. And when it comes to the economy, it remains the top issue. And when you look at every single economic issue, whether it's rising consumer prices or whether it's interest rates, Trump beats Biden across the board. But we should note there's some caveat when you look a little bit deeper into the data that can help current President Joe Biden. One, the fact of the matter is he would just need to make up those numbers of people who voted for him in 2020 in these key states, but also the fact when you ask people how they're feeling about the economy, when they look at how the nation is, what the direction the nation is going, they find it very disappointing. But when you ask them about your own town and your own economic progress in your town, those numbers are starting to trend more positive for this president. And that's why potentially, Jonathan, with inflation coming down and an unemployment rate below 4%, when it comes to the economy, the timeline could be on Joe Biden's side going into November.
Or we're just finding out it's personal, Anne-Marie. It's just personal.
Potentially. I mean, when you look at people just also think that when you ask them what do they hear about President Biden, they still think that potentially he is too old. They trust the way they felt when former President Trump was in office. They felt maybe they were more secure. Immigration also ranks up. Potentially it is personal. We're going to also see something that's going to be a problem for the president next year, fighting this impeachment inquiry in the House. What I found very interesting in this poll, about 1 in 5 Democrats actually support this impeachment inquiry, but we should note it's going nowhere because he's not going to get convicted in the Senate, as Kaylee will tell you.
Katie Lyons will tell us that right now. Katie, the hits keep coming, though.
Yeah, they do. If anything, this just keeps scrutiny around the president and his family in the spotlight. As Anne-Marie says, this likely isn't really going to go anywhere because the Senate is never going to vote to impeach this president. And also House moderates who are in Biden districts makes them vulnerable when it comes to re-election, may have voted to formalize this impeachment inquiry. But at the end of the day, John, what launched yesterday really is just a formalization of an inquiry. This is not an impeachment vote. That said, this vote still was done along party lines, 221 Republicans voting yay, with 212 Democrats voting nay, essentially just legitimizes the process that started months ago when former Speaker Kevin McCarthy launched this inquiry without this vote. Speaker Mike Johnson, though, wanted this vote to happen to make sure it stands up to scrutiny if indeed they do move forward with impeachment. Now, they're going to continue work they've already been doing, including trying to hear from members close or members of the president's family very close to him. Hunter Biden, one that was in the spotlight yesterday. Of course, John, he was on the Hill publicly speaking, saying he would speak publicly in a hearing, defying calls from House Republicans to do so, to be deposed behind closed doors. And now the chairs of the House Oversight and Judiciary Committees, James Comer and Jim Jordan, are launching contempt of Congress proceedings for the president's son, John.
Hey, Kelly, thank you. Tough times all round. Kelly Lyons, thank you. Alongside Anne-Marie. Shouldn't be this way. Just had another decent slate of data this morning. Jobless claims, retail sales. Got the Fed chair talking up rate cuts. The economy seems to be doing okay. The equity market's near all-time highs, at or near, depending on where you look right now, going into the close a little bit later. And yet the rest of the country just does not feel it when they think about the leadership of this president in this White House. Equities right now positive by 0.5% on the S&P. Briefly, with some sector price action. Here's Abby.
It's impressive. A sixth up day in a row, John, and not surprisingly, most sectors are higher, led by real estate, looking really good as yields spiral lower. Let's take a look at a sector, though, in the month of December is doing great, and you can see lots of green there. The home builders already up 13% after gaining 20% in November, all-time high, as folks think that yields are going lower, clearly, but mortgages may go back below 7%.
Abby, thank you. Your trading diary coming up next.
Adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
This is Bloomberg.
Look at this move right here on the small caps. The Russell up by more than 2% again. The S&P up 0.5%. Let's get straight to the trading diary. What you need to be looking for over the next couple of days and into next week. Tuesday, BOJ rate decision. Wednesday, Micron reporting after the closing bell. Thursday, US GDP and another round of jobless claims. And next Friday, remember the bond market closing stateside early for the holidays. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Boy, we've got some smart people coming on today to talk to us about the Fed and these markets. Let me highlight just a couple of them for you. Jay Hatfield, CEO of Infrastructure Capital Management. Boy, he's been right on this. He's been calling for the Fed to cut rates for a long time. Looks like he might be right here. Neil Grossman, another one of those big brains, former CIO TNKG Capital. He's going to join us as well to give us his thoughts on this Federal Reserve, the central banks, and these markets, which are moving higher yet again today after the big, strong move yesterday. Big volume today, so there's conviction buying out there, folks. We'll keep on top of that. But first, let's kick everything off with John Tucker and the Bloomberg Business Week.
Yeah, it's a record watch. NASDAQ 100 on pace for record close. The Dow adding to its record from yesterday. S&P 500 around just under 70 points away from its all-time record high. And the smaller cap stocks captured by the Russell 2000, they are higher. That is up 2.8% so far. We had data this morning, retail sales, jobless claims, reinforcing the soft landing narrative. And Jerome Powell's lack of a pushback against the market's dovish bets also helping renew the surge in treasuries. 2-year, 6 basis points lower, 435. The 10 under 4, 394 right now. That's 6 basis points lower. And the rate cuts, clearly the next step for the Federal Reserve, according to Ian Staley at J.P. Morgan Chase.
I think Jerome Powell is fixated on delivering this soft landing. And I think what's changed is the inflation data is coming down. They are seeing good evidence that that job is done. And they are particularly worried that they're in restrictive territory.
But rates markets are pricing in fewer, deeper rate cuts than Fed officials wrote in the dot plot yesterday. Central Bank talking about 75 basis points of cuts, while traders are looking about 150 basis points of cuts. Right now, the S&P 500, 21 points higher, up 0.5%, 47.28 on the index. The Dow up 69 points, 37,160. Russell 2000 up 54 points, up 2.8%. The NASDAQ 100, 44 points higher. That is up 0.3%. And one of the stock standouts, mRNA, that's Moderna, up 15% right now. Carmen's going to take a deeper dive into that in just a moment. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Molly and Paul.
John Tucker, thank you so much. We appreciate it. Molly Smith back again. Thank you for sitting in here, Molly. And you're going to be happy today because you cover the economy. It's all about the economy in the Federal Reserve.
I am thrilled. I'm so in the element today.
There we go. Very good. Who doesn't like talking the economics and the markets and central banks and all that kind of good stuff? We do. That's why we do it here at Bloomberg. So it's Molly Smith, Paul Sweeney. We're live here at the Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com. Search Bloomberg Radio. Again, a big move in the markets, big volume. I'm talking just well above 30-day average across all of the exchanges there. So, again, some conviction buying here. Let's see where the action is under the hood. Carmen Reineke, she covers the equity markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Carmen, what are you looking at today?
We'll start with Moderna, just because it was already mentioned. So shares are up about 16% right now. The vaccine company developed a vaccine with Merck & Co. That prevents the recurrence of severe skin cancer for 3 years. So basically, patients with severe melanomas who took both this vaccine and Keytruda, which is a key cancer drug that Merck has developed, were 49% less likely to die or have their cancer return than those who only took Keytruda. So both companies are now testing, this combination with other forms of cancer. And Moderna shares are up a lot. I mean, this is a big deal for Moderna. It's one of the, COVID vaccine makers that's just gotten really, really hit this year. Shares down, more than 50%. So they're looking for new things, new places that they can grow their business. And this is a really promising one. Shares of Merck are kind of unchanged.
I think for Moderna, they're looking for new uses for its messenger RNA technology to fight flu, RSV, and cancer. So that messenger RNA was so important for the COVID vaccine, and hopefully it's some other uses as well.
Yeah, exactly. And this is, another one that we see jumping into cancer as sort of like the new growth space. So another big story today, Adobe shares are down right now about 6.5%. It's set for its biggest one-day drop since May after giving a full-year forecast that just didn't meet Wall Street expectations, especially on revenue. The bar was set really high, I think, for Adobe going into its earnings report. It's also a company that's really flown this year. It's up more than 70% on sort of the artificial intelligence hype. And I think investors are really just looking for some of the tools that they've developed using AI to pay off sooner rather than later. And this just, didn't really meet expectations and seems much more cautious, I think, than people wanted to see going forward. That said, some analysts also pointed out that Adobe has sort of a habit of giving very conservative guidance forecasts.
Smart.
We say it all the time here. Under promise, over deliver.
Yep.
Right. So, we'll see what is to come there. The company also disclosed on Wednesday that the FTC is investigating its subscription cancellation practices. So that is something that could also be moving the stock. It could involve significant monetary costs or penalties for Adobe.
Well, in the Bloomberg reporting, it says the guidance suggests the company could take longer than anticipated to realize meaningful contribution from its generative AI products, wrote Bloomberg intelligence analyst Anurag Rana. So there's some smart voice there. So it's there, maybe just it's a timing issue. Maybe.
Exactly.
Okay.
Yep. So the last one that we're looking at is Apellis. That is down right now more than 20%. Yep, about 21%. The drug maker said it expects European regulators to adopt a negative opinion on an eye drug. That meeting will be in January. Apellis has already said that if the negative opinion is adopted, it will appeal and seek re-examination. And I think it's worth noting that this eye drug sort of in question is already approved in the U.S. by the FDA.
This is just a European regulator that's question. Okay, got it.
All right. Carmen, thanks so much. We appreciate it. Carmen Reineke, she covers all the equity markets for us. Hey, how about, Molly, retail sales came in?
Yeah.
Pretty darn solid here.
Fuego
does that
today.
suggest, the holiday season is going to be good for the retailers, I guess?
It's weird because so far it largely hasn't been from what we've been hearing, but I think this does support, though, from what we could see in the retail report, that department stores had a bit of weakness while you saw the real strength was in the online retailers. So that's definitely seems to support what we've been hearing so far coming out of Black Friday and Cyber Monday deals, that the brick and mortar stores were really more the weak area, but e-commerce did well. So, yeah, I mean, still more shopping to be done in December, I would think. And but this certainly looks, you know, obviously a little bit funny after people, you know, were cheering the pivot yesterday and that growth is slowing, but, you know, in line with the soft landing. I think that still is happening. It's just, this was certainly more of an emphatic, you know, up arrow on the report.
A couple of numbers just to highlight here. The retail sales month to month was up 0.3%. The consensus was for a decline of 0.1%, which would have been even with last month. So better than last month, better than consensus. The control group, retail sales for the control group, I'm not sure what the control, Xing out auto gas and stuff like that. Anyway, up 0.4%. The consensus was 0.2% gain, so twice as good as the consensus, and last month it was 0.2%. So pick up across the board in retail sales, once again showing that the consumer's in pretty good shape. Initial jobless claims came in a little bit better than expected, better than last month. So again, some strong economic data.
Yeah.
Combined with the fact that it looks like the Fed's ready to pivot, boom, you get a big move in the market in the Russell 2000.
Stocks are ripping.
Stocks are ripping. Yields coming in. You got the 10-year now, 3.95% on the 10-year. Again, remember, back in late October, 5%. So a big move down in rates here. Let's check in with Ed Harrison. He's the senior editor of Bloomberg News. Get his thoughts on these markets. Ed, thanks so much for joining us via Zoom here. What do you make of what we heard from Fed Chairman Powell yesterday, and then maybe the market's reaction to it?
Yeah, I think there are two things there, Matt. One is that there was no pushback from the Fed, and I think that's the most significant of the two things. The second, obviously, is the dot plot, which was relatively dovish. But when you add those two together, particularly the one with the lack of pushback, it says that markets have room to rip from here. And this is exactly the opposite of what I was thinking ahead of the meeting. I was writing that the Fed would at least do a perfunctory pushback, but that's not what we got. When you look at the transcript of what Powell, when he was asked questions, Nick Timiraos of the Wall Street Journal, he asked him, look, you know, we've gotten a lot of easing of policy on your behalf by anticipating a funds rate next year that's a full percentage point lower in September. And Jerome Powell said in response, he said, look, you know, we're just going to do what we have to do. We're not going to think about the market. They're going to do what they need to do, and we'll meet somewhere in the future in some place. And that was enough for the market to say, okay, look, we have no pushback here. We're definitely just going to let it go.
You know, it's interesting, Ed, because when you think back to the November meeting, that was really when Powell had pushed back on all of the, you know, or really paid more attention, I should say, to financial conditions. And that was a time when Treasury yields were really going higher. And, you know, it's like, oh, well, this is maybe kind of nice. You know, they're doing a bit of the work for us. Like, we'll take that. And now there's been so much easing just built in the Treasury market for people thinking that this pivot was coming. Of course, now that the decision has come, stocks and Treasuries just ripping further. So is there really, does Powell still care about the, you know, financial conditions at this point, or he's kind of just willing to let them go as they please?
Yeah, I think that he's given up on looking at it. It makes a lot of sense in terms of thinking about where we are in terms of the easing cycle or the tightening cycle. We're basically, by giving up on trying to get financial conditions in order, he's moving to a full-on, you know, data-dependent mode. That means that we're not giving you any guidance except for what you get in the SEP. And as the data come in, we're going to do what we need to do, and you guys do what you do. So in terms of going until the end of the year, you know, we got the retail sales that you guys were just talking about, which were bullish, as well as the initial and continuing claims, and the markets just completely disregarded that. You know, you look at the Treasury markets at a minimum, and they continued to go below 4% on the 10-year. And so what that says is that you know the path of least resistance until the end of the year is towards lower yields. And then we'll have to see what the data show. And when the data come out, we're going to see some volatility because there's no guidance as to what the Fed's reaction function will be. Everyone's now thinking March for the first cuts, but if we see those retail sales numbers again and again and again, like that we saw today, then people are going to have to push back those expectations.
You know, I think one of the risks here, as I just kind of look at the market reaction yesterday and today, is that, you know, Fed Chairman Powell may have lost the ability to rein in this market if the data does in fact go the other way. I mean, it's just he seems to have kind of unleashed the wild spirits, if you will, of this market. I'm not sure how he ever gets back to any kind of cautious narrative here. I'm wondering if he's, I'm going to say misplayed yesterday, but maybe it was misinterpreted by the market, or it just seems like it's tough to close the barn door now.
Yeah, I think that is a worry. My worry is, and I've said this before, is 1999. When I talked to you 2 times ago, I think we were talking about partying like it's 1999. He's allowing that to happen, and obviously, if that happens, then what you see is a harder landing down the line. It's very difficult to see a scenario in which you have unemployment at 3.7% for an extended period of time without the Fed having to continually be at the ready to tighten financial conditions. And that's where we're headed into 2024. And with markets increasing the price earnings ratios, increasing their bets on cuts of interest rates, it sets up a very nasty headache down the line, potentially.
Yeah, I mean, let's just roll it back just a little bit here for some perspective. So we had that awesome jobs report on Friday of last week, great payrolls number, unemployment rate down, and wages were up. Fast forward to this week, the CPI report, obviously, a bit of concerning, I would think, for Fed officials there, that service sector inflation still very much powering ahead. So not much of a dent there. And then, of course, they didn't get to see today before they met the retail sales and jobless claims data. But you would think all of that would be supporting higher rates at this point and not be talking about cuts.
Well, I'd be interested to see what Michelle Bowman has to say, because I know that Powell, he flicked at her a little bit so as to not leave her dangling in the wind. She's one of the few people who thinks that rates should be higher. He said that we could go either way, but really it was a very perfunctory, very lip service type of comment on his part. I think that, the wind is blowing towards easing, and to the degree that we see those numbers that you were talking about, Jess, go down, then we are going to get the easing that people expect, perhaps not as quickly as they expect, but the Fed is primed in that direction, and I think that's the path of least resistance at this point in time.
So, Ed, I mean, what's your view of inflation here? I mean, I guess the Fed feels like it's on the right path, which it arguably is, but I guess it's just a question of timing to when we get to the inflation level that the Fed really looks at. What's your view?
My view is that we're in an interesting paradigm that we haven't seen over the last 20 years, where you have the deglobalization, you also have a dearth of workers as the baby boomers leave the working population. So there are some structural changes that create upward pressure on inflation in the U.S. in particular. And so, with core PCE inflation at 3.5%, that's almost double the Fed's mandate. Really, you could get down to something in the 2s, say like 2.9, and the Fed could start to ease. But beyond that, it's going to be very difficult. And so I think that there's going to be a lot of pressure on the Fed going forward to continually be at the ready to tighten financial conditions, because inflation is likely to continually be sticky given those headwinds.
20 seconds here, Ed. When's that first cut coming?
I would say the first cut is going to come June. That's what I would say.
June, okay.
And so we're going to see some steepening as a result of that, and then it's going to be a rapid cut, because by that time it'll be clear that the economy has deteriorated.
Ed, thanks so much for joining us. Really appreciate it. Ed Harrison, senior editor for Bloomberg News. We certainly recommend Ed's Everything Risk column. Good stuff, good reads all the time. And we appreciate getting a few minutes of his time. Again, looking at the market here, giving up some of the gains, but still kind of in the green here. We've got the S&P up about 0.25%. The Dow's pretty flat at the moment. NASDAQ up 0.3%, and the Russell up 1.9, just under 2%. So giving back some of the early gains, some big volume trading this morning. So there's some conviction out there. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. Some promising news from Merck and Moderna. Results from a new study, it showed a personalized vaccine developed by the two companies helped prevent the reoccurrence of severe skin cancer for 3 years. Moderna CEO Stéphane Bancel spoke about it earlier on Bloomberg.
Skin cancer is a scary thing, and what we are doing at Moderna is we're using our technology to develop individualized treatment where we make a different chemical drug for different patients. Everybody gets a different drug customized to the DNA of their cancer cell, and the data are striking.
Now, that data says that patients with severe melanomas who got the vaccine and Merck's cancer drug Keytruda were 49% less likely to die or have their cancer return than those who only use Keytruda. Now, Moderna right now, it's up about 12%. Merck is down about 0.5%. And you can add Medifast to the list of companies now adding weight loss drugs like Wegovy to their diet arsenals. Bloomberg's Joan Doniger has that story.
Dow Jones says Medifast usually used coaches and low-cal shakes and bars, but now it's investing $20 million in LifeMD. That's a telehealth company that provides access to doctors and nurse practitioners who can prescribe the drugs. And now it turns out Oprah is using them. She told People magazine she is taking weight loss medications as what she calls a maintenance tool. She didn't say which one. She's a board member of Weight Watchers.
Medifast down 2.5%, LifeMD down almost 1%. And Southwest is cutting its advertising on X. The carrier says the pullback is extending to other platforms as well as it's been interacting more with customers outside of social media. I'm Lisa Mateo. This is
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Pairing some of the earlier gains, as Paul mentioned, but the Dow still adding to its record close. And the NASDAQ 100 on track for a record close today if these gains hold up. S&P 500 about 75 points away from its record. In that index, you have 7 of the 11 major industry groups. They are higher. Real estate, energy, the leaders. Moderna, the leading individual stock in the SPX, that is up right now about 12%. How to characterize the rally after the Fed meeting yesterday. Here's how David Sowerby at Ancora Advisors puts it.
I remember when we talked in early November, and I joked, I said head lifeguard Jay Powell blew the whistle back in the pool.
Yep.
And now it's cannonball off the high dive.
still works. The data this morning shows, among other things, U.S. retail sales advancing at the start of the holiday shopping season, topping forecasts. You can't keep down the American consumer. S&P 500 up 15 points. That's a rise of 0.3%. 47.22 right now. The Dow up 50, 37,142. The Nasdaq 100 up 25 points. The Russell 2000, 2% higher, up 2.1% in fact. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, very good. Thank you so much. Molly Smith, Paul Sweeney. We are here live on our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So you can head over to youtube.com and search Bloomberg Radio, and that's where you'll find us here. So as John was just reporting, we do have green on the screen. The S&P is up about 0.3%. But what I'm noting here is just a big volume this morning on the trading. We got the S&P 500 volume about 80% higher than the 30-day average at this point of the day.
Heavy.
The NASDAQ up over 100% relative to the 30-day average. So there's some conviction in some of this buying activity this morning. So people certainly liked what they heard from the Fed yesterday. Let's bring in Jay Hatfield. He's the CEO, founder, and portfolio manager at Infrastructure Capital Advisors. He joins us live here in the Bloomberg Interactive Broker Studio, like he always does. Never mails it in, never phones it in. The kids could learn something from that. Jay, I don't know, what did you take yesterday? It certainly surprised, I think, the market with Fed Chairman Jay Powell's, I guess, tone of comments, maybe even the dot plots as well. What did you take away from it?
Thanks, Paul and Molly. Well, we were surprised, like the market. We had thought that the Fed was only going to have 2 cuts priced into the dot plot. So it's a welcome relief. But I think that you've had some new participants that's come on to the Fed, like Austin Goolsbee, and they're looking at what they should look at, which is more a mosaic of data, instead of myopically focusing on this PCE core. We think that's a disaster and makes the Fed fundamentally flawed.
Disaster, really?
Total disaster.
A
Yeah.
lot of headlines.
What's wrong with core PCE?
The problem is you have to look, if you watch core PCE, then you'll end up being an incompetent Federal Reserve, and you'll call inflation transitory when it's skyrocketing. So what you should do is look at PPI, look at CPI-R, that's our index, or in other words, adjust the horrible shelter component of BLS, and then use something called judgment instead of a rule that Greenspan used to use, who was the real star of monetary policy. And so it seems like they've taken a leap and are using judgment instead of just focusing on this one measure that's massively flawed.
So which ones are, I mean, well, you just rattled off a couple of metrics there. I mean, which one do you think right now has the most of a signal right now for inflation that you're really paying attention to?
Well, the reason that we've kind of nailed this cycle since the pandemic is that, unlike the Fed, we look at monetary policy, which drives housing market, and then we're lucky because we're energy investors. We have a pipeline fund. I founded a pipeline company. So I would argue, if you have those 2 inputs, you can ignore monetary policy. Just look at the housing sector and energy prices, and you will be a good forecaster. So right now, housing prices did come way down. They have ticked up. We talked about the last time, so that's a little bit of risk. But rents are low, so we might have to have yet another index that has just rents.
Yeah, like you said, you would not know that looking at the CPI index of shelter.
Or even our CPI-R is ticked up because Case-Shiller went up, but rents are down. Again, this is the mosaic you have to look at. So we do think that inflation is contained, and we are pleasantly surprised that the Fed seems to agree with us right now.
All right, Jay, make sure our headline writers are ready here. What have you done to your S&P 500 price target, and why?
So we raised it this morning, and the best way to summarize why is a terminal command, MIPR, which I would recommend everybody boots up. We sort of sadly only figured this out about 2 weeks ago.
That's market implied policy rates for everyone tuning in.
Yeah, so if you look at one of the columns, it's a sea of red, but that's good red. So those are all the rate cuts that are priced into all the major bond markets in the world. And so it's kind of obvious this data should exist because we have it in the US, right? Because there's a futures market in every country. And so what's wildly bullish about this is that we were on 2 or 3 months ago, and we had this non-consensus call, that the euro economy was terrible.
Yep, you did.
And that the eurozone would be forced to cut, or ECB would be forced to cut. But the good news is you don't even need to listen to our rationale, because that's what market participants believe now. So I guess they're avid listeners of Bloomberg Radio. And also, if you hover over the eurozone chart, you can put up a GPO chart, and you can see that it did plummet over the last 2 or 3 months. So this is the heart of the bull case. But it's even better because the ECB was very recalcitrant today and has what we think is kind of a crazy forecast of plus 0.8% for GDP next year, which we strongly disagree with. But the good news is you don't need to agree with our variant view on their economy, because market participants in the Eurozone who trade Eurozone futures agree with us. That number did tick down a little bit. It was 144 is the negative, the cuts priced in next year. After Lagarde's speech, that ticked down 6 basis points. So it was a pretty hawkish speech.
All right, so let me just summarize what the good folks at your firm, Infrastructural Capital Advisors, did this morning. They raised your price target for the S&P 500 to 5,500 from 5,150. That's based on a 21.5 multiple on S&P consensus earnings for 270. So that's your 2024 year-end target?
Correct.
And for perspective, we're right now at 47.25.
Correct.
So that's
okay.
good.
Yeah.
What's the risk to your outlook here? Is it earnings risk? Is it macro risk? What are some of the issues you're concerned about?
What a lot of people don't appreciate is the multiple on the market is 90% driven by long-term interest rates. So the reason we upgraded it is that we had this non-consensus call that rates were going to drop from 5, but that looked a little bit problematic, so we were pretty conservative about 10-year. So, but at a 350, that implies a 21 times multiple on S&P EPS. And the consensus is 270. And by the way, we did this methodology last year and came up with our 4,500 target. So it's just a very straightforward, if you don't like, as you're pointing out, don't like one of our metrics, you can just plug in your own. We're using 3.5%, which implies 21.5 actually, and 270 on earnings. And we are bullish about earnings. And we think most people miss the dynamic that earnings normally go up by 10%. You don't need margin expansion. You don't need a very strong economy, because companies are retaining earnings about 70%, invest about 15% after tax. That implies 10.5% growth. So the earnings estimates are normal, not crazy. And we don't think you need to debate that and wring your hands about it, because it's the companies reinvesting their cash flow, primarily driving earnings.
So you had started off by telling us that the Fed and the dot plot yesterday indicated 3 rate cuts. You think that there's only going to be 2. The dot plot, though, there was a pretty wide range in there. You know, that's just the median with 3 cuts, but there are 8 participants who saw fewer reductions, 5 expect deeper cuts. Who do you, I mean, we obviously don't know whose dot really belongs to who, but you could take a reasonably educated guess. Who do you think is really the voice that you're following the most right now?
Well, we think that the thought leader initially was really Goolsbee, that he came in and sort of said the emperor has no clothes, that the labor market is not the key driver of inflation. And there are, I think that you got to the heart of the matter, is that Powell was probably forced to come off his tone because he had a number of participants saying that inflation is actually plummeting, that the economy is at risk. We think it's fine, but it is at risk if they keep rates. Because keep in mind, if inflation really is going down, then real rates are skyrocketing if you keep them flat. So it is encouraging that there apparently has been a little bit of a palace coup, and the hawks have been moved more to the center or even dovish.
Off-topic question. UC Davis is where you graduated from. I'm a huge fan of the University of California system. It's just amazing what they've done over generations, haven't they?
Yeah, so the advantage too that particularly those Northern California schools have, like UC Davis, is that if you look at a map, if you're not from California, it's extraordinarily close to Silicon Valley.
Yep.
So those are great training schools. You don't learn, like my kids, Latin and all these other things. But you learn, I was trained in business, economics, medical. So just a real professional school. It's practical. It's meant for public, kids as top 10% students. So probably the model of the future, although these are great schools we have in the Northeast.
Yeah, but it's just, I mean, Professor Galloway from NYU, I'm a big fan of his. He's a huge proponent of the UC system and what it did for him and what it does for generations of kids in California to bring them to the next level. And that's powered a lot of the economy, the great economy for California over the last 100+ years. So Jay Hatfield, and then you got your MBA from some place in Philadelphia, I don't know. Jay Hatfield, he's the CEO, founder, and portfolio manager at Infrastructure Capital Advisors, raising the price target big time to 5,500 on the S&P 500 year-end 2024. Right now, let's head down to Washington, D.C., world and national news with Amy Morse.
All right, thank you, Paul. Israel is keeping up the attacks on Hamas today, despite worsening conditions in the Gaza Strip. UN officials say roughly 90% of the Gaza population is displaced now by the relentless bombing. About 1 million people are now facing starvation. The Palestinian Health Ministry says vaccinations for children are also dwindling in Gaza. A new Bloomberg News Morning Consult poll shows former President Trump has pulled ahead of President Biden in all 7 of the swing states, likely to decide next year's election. Overall, Trump leads Biden 47 to 42% in those battleground states within the margin of error. Bloomberg News politics reporter Gregory Cordy.
Now, for the first time, every one of these 7 swing states, Trump is now leading in. Michigan was the one that was tied the first 2 times we did this poll. Now President Trump is leading by 4. And so this is a pretty good poll for him. And it shows how President Biden continues to struggle to convince voters that his economic policies are working.
Bloomberg's Greg Cordy says President Biden has lost support among suburban women in Michigan and voters aged 18 to 34. The House of Representatives, meanwhile, voted to authorize the ongoing impeachment inquiry into President Biden. The measure passed on a straight party line vote. House Oversight Committee Chairman James Comer of Kentucky.
It's very clear the White House has been obstructing our investigation. I think the message sent today is very loud and clear. We expect them to comply.
Meanwhile, Democrat Jamie Raskin of Maryland says these are attacks on the president, and he calls them baseless.
They understand there's no real evidence to support any presidential offense here. They haven't even named what they think the crime is.
House Democrat Jamie Raskin says the impeachment inquiry is purely about next year's election. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Day after the dovish Fed meeting, today's strong retail sales and lower jobless claims look to be creating a best-case scenario for the economy. The Nasdaq 100 set to close at an all-time high. The Dow adds to its record close from yesterday. And if you have cash to put to work, Peter Shear at Academy Securities says put it into risk assets.
You know, I think it has to chase this rally. So I really wanted to pull back. I thought we'd had this great run. But as I look at what the Fed did, I think you have to keep these positions. And I think you want the laggards still. And including in the laggards, I think you look at disruptive tech, right?
From stocks to treasuries, credit to commodities, everything was up after the Fed projected more rate cuts for next year. And I have to mention Apple rally there, the world's most valuable publicly traded company, showing no signs of easing after closing at a record yesterday. The iPhone maker's market value approaching that of Europe's largest stock market, France. It's higher than France, the stock market there. Right now, shares of Apple 0.6% higher, 199.11 on that stock. The major averages S&P 500 up 14 points, 47.20 on the index. The Dow up 75 points, 37,167. Nasdaq 100 is right now shedding some of the earlier gains, now up just 2 points. And the Russell 2000 of smaller mid caps, that is 2% higher. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, thank you so much for that Business Flash. It is Molly Smith, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio, and that's where you will find us. Lots of economic data today, in addition to what we heard from the central banks. Retail sales leading the way here. Just the headline, retail sales month to month up 0.3%. Yep.
Yes.
Consensus was a minus 0.1%, so stronger than expected. The sales control group up 0.4%. Consensus was 0.2%. So some very solid numbers coming out of the retail sales, and maybe that bodes well for the holidays. Mari Shore joins us. She's a senior equity analyst. She follows the retail industry really closely for Columbia Threadneedle Investments. She joins us via Zoom. Mari, what did you make of the retail sales numbers today? They looked, at least to me, pretty darn solid.
Yeah, thanks again for having me. You're right. The print this morning was very strong. When we look at the core sales, they accelerated 140 basis points month over month. Obviously, it's been a good start to the holiday, and I think more favorable weather also helped the month of November, rather than an underlying change in the consumer.
Well, and lower gas prices too, right? That's got to be a big help.
Yeah, lower gas prices, food disinflation continues, and that has been a big pressure point on the consumer. But what we see outside of electronics is really a continuation of the themes that we have been discussing. So we continue to see the consumer spending more on needs over wants, with particular strength in health and wellness. Also relative weakness in categories that were strong during the pandemic, like home, and then e-com outperforming stores. So it has been a strong start to the holiday. Promotions continue to run in line with plan. But I would say we're being very mindful of the lull that we typically see in early to mid-December. And I think it will be really key to watch how the business progresses through the month as we move into the final push year. A lot of retailers are very focused on managing margin and ending the season clean on inventory. So we could see promotions increase as we continue to move through the month.
All right, let's just stay with that dichotomy right there you were just touching on between e-commerce and brick and mortar sales. Why is that the case right now, especially if you just said, weather's decently good for the winter up here, especially in the Northeast, and that gas prices are low? Would think that would support more people going out to the stores.
Yes, absolutely. I think it's really just a return to the trend that we were seeing before the pandemic, which is e-commerce gaining share from stores. I think the companies best positioned are those with broad assortments, value offerings and convenient means of picking up product. So when you think about the e-commerce business as reflected in retail sales, it's mainly Amazon. Amazon represents over 40% of the category. And we've seen from their numbers, they are, I think, both driving the category and taking share. Walmart is the other company that I would highlight as still posting very strong double-digit growth in e-commerce. So those would be the two names I see taking share within that channel.
Hey, Mari, there's on the very off chance that I do actually wander into a store this holiday season, am I going to get any promotions? Am I going to get any deals? What's happening there?
You will see promotions, but again, very much in line with plan and expectations. I was out in the stores yesterday, and the level of promotion and markdowns is very much in check. And I think this just reflects the lean inventory position heading into the holiday. You know, at this point in the cycle, retailers are very mindful of the macro backdrop and the weak demand backdrop in many categories. And so they're just extremely focused on managing margin and inventory. And I think that's one of the reasons why promotions and markdowns have been pretty much in line and, you know, nothing super aggressive as we start the holiday.
Tell us where some of the retailers are really doing this right now, because, you know, we just did get earnings not too long ago, and I'm thinking back to those, you know, like Home Depot, Lowe's, Whirlpool, all those, you know, bigger ticket items, and, you know, seeing a lot of weakness in those areas. So who's really, you know, capturing more of the consumer's wallet right now?
Yes, you're absolutely right. We continue to see demand normalize and pricing really fall apart in some of those bigger ticket categories that were strong during the pandemic. And we've seen deflation in many of those categories for some time now. I think, you know, some of the best positioned categories are those that fit into the health and wellness trend. So within that bucket, I would include some of the global athletic brands, you know, the Nikes, the Lulus, the, you know, On Running, Hoka. We continue to see good strength there. And even in the beauty category, we continue to see relative strength there. I think that also kind of plays into the health and wellness trend. And then in terms of retailers that are doing well, again, I think it's anyone that is offering strong value, broad assortment, and convenient ways of picking up the goods. So again, I would highlight Amazon, Walmart, and some of the off-pricers like TJX seem to be taking share at an even greater pace as we move through this year. And honestly, I think all of those trends continue as we move into 2024.
Mari, as I walk to Penn Station this afternoon, I'm going to walk down Fifth Avenue, Madison Avenue. Give us a sense of how the luxury part of the market is doing.
Not good.
Not good.
You know, we've heard it from all the global brands. You know, a lot of these retailers are now private, so Saks, Neiman. But the checks that I've seen suggest their business is down mid-teens.
Wow.
And again, I think this is also just kind of coming off the strength that they saw during the pandemic. And also, you know, consumers having lots of other places to spend their money now, like travel obviously remains very strong relative to some of these categories. So listening to some of the retailers, some of the brands, North America luxury is definitely still a sore spot.
All right, Mari, thank you so much for joining us. Mari Short, one of our go-to voices on all things retail. She's a senior equity analyst at Columbia Threadneedle, and we like to chat with her when we get some retail sales data here. And again, it came out on the macro level for the month of November, much stronger than expected, much stronger than last month. You know, calling out, as retail people tend to do, calling out weather.
They do
all the time.
I know. Yeah. I mean, obviously, like I said, the gas prices. I think you can't ignore the impacts from that. That was really. I mean, that's what you see every day, right? Yep. You know, those prices at the pump. John Tucker, I'm sure, will tell us whatever the Wawa reading. What is that right now, John?
I know it was like 315-ish. Route 30. I filled up this morning.
That's kind of high.
You know what?
For this?
My apologies to Wawa. I went to the Quick Check this morning.
Really?
Whoa.
In Highlands on Route 36. That was.
Okay.
You know, speaking of Wawa, not to, but I've just noticed they've really upped their game on their facilities. I mean, they're just these huge new facilities.
They are beautiful.
Stores and gas. Who knew it? This is Bloomberg. Let's get some company news right now with Lisa Mateo.
That's one of my favorite spots, that Wawa. Good morning, guys. Well, more fallout involving General Motors' self-driving vehicle unit. We get more from Bloomberg's Joan Doniger.
GM's self-driving Cruise unit has fired 9 top executives as regulators investigate that accident in October in California that saw a Cruise robo-taxi hit and drag a pedestrian 20 feet. Cruise lost its license to run self-driving cars on California roads after that. Since then, GM's taken a bigger hand in running the company.
GM is up about 4.5%. And sources tell Bloomberg Credit Suisse dismissed its entire wealth management team in China, scrapping its ambition to become one of the biggest foreign money managers in the country. This as UBS Group decided not to take the staff. Bloomberg's Nick Comfort says it's surprising.
For UBS, Asia and wealth are big areas of focus. These are key driving areas. It's a business that they love. However, I think it does show, speaking to that complexity of that transaction of incorporating Credit Suisse, that they aren't willing to hold on to all the business. They are, if it's too complex, if it's too risky, then UBS does not want to carry it forward.
Now, those let go are said to include at least 20 relationship managers and investment consultants, as well as the CEO of Credit Suisse's securities venture, UBS Group. Right now, they are up about 3%. And Etsy plans to cut about 11% of its staff, or about 225 employees. It's part of a restructuring plan. Its CEO said the e-commerce company is still more than double the size it was in 2019, and they need to adjust for today's realities. Etsy right now, they're down nearly 1.5%. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets right here, holding on to the gains. S&P 500 up 0.4%. The Nasdaq up at 0.4 as well. The Russell, the small cappers, up 2.2%. So again, I'll call out the higher than average volume as well. So there is some conviction out there in this morning trading. Yields come in sharply. The 10-year Treasury is down 9 basis points, 3.92%. That is the low of the day. And recall, October 19th, the 10-year Treasury was at 5%. So a big, big move in yields. A little bit of a bounce back here in oil. WTI crude oil up about 3.5%. We're now just below $72 per barrel. And Bitcoin's off 1.3%, still holding above $42,000 per token for Bitcoin. Let's head down to Washington, D.C. right now. We'll get to world and national news with Immerse.
All right, thank you, Paul. White House National Security Advisor Jake Sullivan is in Tel Aviv. He's meeting with Israeli officials as tensions between the U.S. and Israel have reached new highs. Israeli Prime Minister Benjamin Netanyahu had pushed back against criticism of his country's war against Hamas, saying that they will continue fighting until Israel reaches victory. The U.S. is also working with allies to create a multinational effort to protect ships passing through the Red Sea. More from Washington and Bloomberg's Steve Potusk.
It's an effort to stem a surge in attacks by Houthi fighters that has provoked unease about commercial trade passing through one of the world's most vital waterways. An announcement could come any day following weeks of consultations about the violence, which began after Hamas militants attacked Israel on October 7th. The Houthis are based in Yemen and backed by Iran. Deputy Defense Secretary Kathleen Hicks tells Bloomberg this is going to take an international solution. Steve Potusk, Bloomberg Radio.
House Republicans have threatened the Food and Drug Administration with a subpoena as they intensify scrutiny of the agency's efforts to deal with quality control for drugs that are made in India and China. The letter from lawmakers cites a Bloomberg report showing the FDA abruptly ended a program of unannounced inspections in India and reports of FDA efforts to undermine the Defense Department's bid to examine drug quality through independent testing. Flags across Connecticut are at half-staff today, marking the 11th anniversary of the Sandy Hook school massacre. It was on this date in 2012 that Adam Lanza shot and killed 20 children, 6 through 8 years old, plus 6 educators at Sandy Hook Elementary School in Newtown. Most of those children who survived are now high school seniors. Public schools in Newtown are operating on a 3-hour delay today. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Molly.
All right, Amy Morris, thank you so much. We appreciate it. Molly, crazy story. We've been talking about these GLP-1s, these weight loss drugs. It's been a huge, huge story, not just in healthcare, but across the market in general.
Everywhere.
Here's a CNN story that just kind of blows me away. Poison centers see nearly 1,500% increase in calls related to injected weight loss drugs as people accidentally overdose. So poison control centers across the U.S. say they're seeing a steep increase in calls related to semaglutide, an injected medication used for diabetes and weight loss, with some people reporting symptoms related to the accidental overdoses. Some have even needed to be hospitalized for severe nausea, vomiting, and stomach pain. This is terrible, but their cases seem to have revolved after they were given intravenous fluids and medications to control nausea.
Jeez, I mean, I was just saying, but when we were reading this story before, remember John and I on a different radio show on Monday saw that there was a woman who is, I believe she is suing Novo Nordisk because of the extreme vomiting that she endured while on Ozempic for about a year and lost her teeth because of that. So
I don't know.
Some of these side effects are just, I think we're going to obviously just start hearing more of it as we, more time passes with these drugs.
Yeah, and from my understanding, the way you inject it today is kind of like an EpiPen type of mechanism.
I'm wondering how you then overdose.
Yeah.
Like, do you, because that's like a, already pre-described portion in there, so would think you take 2 of them at once, maybe?
I don't know, maybe. So hopefully we'll learn more about this going forward, but it's going to be a big issue as more and more of these drugs become available in the marketplace. And I always feel like once you come out with a pill format that really works and where they have, that's going to be the
more overdose risk there for sure.
Yeah, we'll have to see. We'll stay on top of that story because it's certainly big in the space of healthcare. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, some more informed discussion. We think Neil Grossman, he's a former CIO, founder of TNKG Capital. He's going to join us in studio to break down what we're hearing from central bankers around the world, particularly Fed Chairman Jay Powell. A little bit dovish yesterday, and we've seen that big reaction in the markets. Then Young Yu Ma, CIO at BMO Wealth Management, joins us to discuss the possibility of a soft landing in the U.S., so we'll get the economic call there. And then Max Abelson, Bloomberg News reporter, he's going to join us to discuss his latest Business Week episode on Bloomberg Originals. He's got a lot of great reporting. It comes out Thursday nights, tonight, 10:30 p.m. Wall Street on Bloomberg Television, so tune in for that. We'll talk to Max, get a little preview there. But first, let's go to John Tucker, kick this thing off with a little bit of Business Flash.
All right, thanks, guys. Stocks attempting a sixth straight day of gains. The Dow closing Wednesday at a record. It's adding to those gains in today's session. Investors also digesting the fresh economic data. Stronger than expected retail sales. A drop in initial jobless claims. Got that this morning. So that reinforces the idea of a soft landing and comes after the dovish Fed meeting yesterday with a pivot from rate hikes to rate cuts next year. Stephanie Roth, the chief economist for Wolfe Research, says the Fed has given her more confidence in her optimistic outlook.
I've been calling for a softish landing. Now I think I just have more conviction in that. The fact that they can cut rates even sooner than our base case. Our base case was Q3 of next year heading into yesterday. We've pushed that up to Q2. And that just makes the runway even that much wider for the soft landing to happen.
All right, here's where we stand. The Dow up 112 points, continuing its record climb, 37,205. The S&P 500, 19 points higher right now. That's at 4725. The NASDAQ 100 on track, at least right now. It's been bouncing up 24 points, up 0.2% at 16,588. So if it stays there, that would close at a record. And some of the real action also, smaller mid-cap stocks, the Russell 2000, that's a rise of 2.3%. And then I think I'm going to steal some of your thunder, but I'll do Moderna real quick because that's a standout. That is up about to 12%. Apple adding to its record close yesterday. Right now, up another 0.4%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Molly and Paul.
John Tucker, thank you so much. Molly Smith, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com. Search Bloomberg Global Radios. John's just reporting gains across the board here for the stocks. I'm looking at the volume here. You can do that with the WEI function on the Bloomberg terminal. The S&P volume, 77% above the 30-day average at this point of the day. NASDAQ up 90% over the 30-day average. So a lot of buying here this morning in the marketplace. Let's see where the action is under the hood. We do that with one Jess Menton. She covers the markets for Bloomberg News, and she's here in our Bloomberg Interactive Broker Studio. Jess, what are you looking at?
Well, we talk so much about the rally broadening out. Something that I like to look at, VXF is an ETF that tracks stocks that are not in the S&P 500. So you do have some large caps in there, but also mid caps and small caps. Up 2% today. So VXF is the ticker symbol on this. Also, if you go back to where it hit a low at the end of October, up almost 20%. So this sort of coordinates with a lot of the things we've been talking about, more breadth in the market there. When it comes to some of these individual movers, though, Foot Locker, ticker symbol FL, up 7%. So on pace for its best day since December 1st. So that did come after it was, especially looking over at Piper Sandler's. So talking about how margin expansion opportunity is coming for that stock in 2024. And so we did see, and I know Molly covers when it comes to the retail sales numbers coming out this morning, a lot stronger than expected for the month of November, especially as those gasoline prices were falling. So when you're looking at some of these retail stocks here, getting a bit of a boon there, but have to mention, we just saw the Dow yesterday close at a record. If you look at the NASDAQ 100, it actually is on pace to also, if it can continue to hold these gains through today, also on pace to close at a record today as well. And then if you look at the S&P 500, off about 1% away from an all-time high. So the last time the NASDAQ 100 hit a record was, of course, in November of 2021. Also the same month when Fed Chair Jerome Powell dropped transitory and sort of ditched that when he was on Capitol Hill. Right, what a time that was. That was also when the Russell 2000 had peaked out. And then, of course, the Dow before this had last hit a record in early January of 2022, as well as the S&P 500. So waiting to see if the NASDAQ 100 can join.
You know, I'm looking at the S&P equal weighted index, SPW.
Yes.
It's now up 11% year to date.
It is.
That's been a big move just in the past 4, 5, 6 weeks because it was kind of flattish.
And
really
people were
lagging.
concerned about that back in May and June. There's a discussion about, of course, that stellar first half for the Magnificent Seven stocks, especially the NASDAQ 100. That was the best first half it had posted in probably a couple decades since the turn of the millennium. So the debate over whether or not this was going to broaden out, and you're starting to see that, especially with the Russell 2000, not just this month, but heading well into back in November too. Stellar weeks there. And so usually when people talk about the January effect, usually that's mid-December when you see small caps begin to pick up. But we actually saw that happening a few weeks before when it typically happens. And of course, tax loss harvesting and things like that going into year end. So when you have a lot of the macro off the calendar after we've gotten past the Fed decision, and of course, next week, the only person that's on the calendar, Raphael Bostic, is there. He's not a voting member this year, but he is going to be a voting member next year. So keep an eye on that for next Tuesday when he speaks.
Yeah, the Russell is up 13% year to date. You know, I think the first time in my career, I got that old tax loss selling call from my financial advisor last year.
Really?
I think the first time. I have not gotten it this year.
Okay.
Which is good. He's like, hey, Paul, we need to do a little work here.
Yeah.
And I was like, where did this come from, dude? I thought I was all in municipal bonds. But,
and everybody likes to talk about the Santa Claus rally period, but that's actually Jeff Hirsch over at the Stock Traders Almanac. His father coined that term, but it's actually technically the last 5 trading days of the year, the first 2 of the new year. So it would technically start next Friday on December 22nd. So that's something I'm keeping an eye on too, because usually he looks at it as if things follow patterns, that's a good sign. But when things buck the trend, that's when there could be a concern. But I don't know, things have been firing on all cylinders here for the market.
The last week in December, Carol Master and I will be holding down Bloomberg.
Really? I love that.
Exactly.
Two legends.
I will not be tuning in, but I will be.
Not because you're not a fan, because you're going to.
Just going on vacation.
Where?
Antarctica.
Why?
That's amazing.
Why not?
There's no beach. There's no golf. What are you doing down there?
Is that the only sign of a good vacation to you?
Exactly.
Sweetie only likes the compound, being at the beach in
Coming
Jersey.
back with a suntan. So what does one do in Antarctica?
Hang out with some penguins.
I love that. Oh, you'll have to send us pictures.
All of it.
Yeah.
Maybe on youtube.com where we're streaming. I don't know. We'll talk to our producer if we could stream. Maybe I'll do a segment from Antarctica.
Yes, can we please
see what the radio
Zoom
signal's
in
like from
and
down
we
there.
could see the penguins.
Got 4 hours to kill. Why not? Jess Menton, thanks so much for joining us. Jess Menton covers all the equities for us. Again, movements in the markets here. We had a Fed that look at the market reaction, took the market by surprise with its
cheerleaders everywhere.
I don't know.
It is a good day.
Just ripping here. Neil Grossman. He doesn't strike me as a cheerleader, but Neil Grossman's here, former CIO at TNKG Capital, joins us here in our Bloomberg Interactive Broker studio. Neil, what did you make of yesterday and the reaction in the marketplace?
First off, good morning and happy holidays.
You too.
I think that was Christmas.
Yeah.
Couple of things, I guess. Number one, I think what I took away, number one, is under the hood, Mr. Powell may have just told everybody he's changing the definition of what inflation measures they're looking for, raising the target. Because I was amazed. The thing that really was most amazing to me was the fact that he said, we can't wait till we get to 2% to start removing or providing more liquidity because that would be too restrictive.
So is that a different message than?
Well, that means 2% is no longer really your target. And not only that, I know we've talked about the fact that we've now going to have close to 4 years or so of high inflation on an average basis. But he's now, I think what's happened is he's raised the probability that getting to 2% is dropping, and the potential for reacceleration is a problem. I mean, look, this whole rally started, I guess 5-6 weeks ago when he made the comment that the market's doing the work for them. 10-year notes were about 5%, give or take. Yeah. And interest rates have dropped a full 100 basis points, basically.
Yep.
The stock market's up something like 20%. As of yesterday, the dollar had been weakening. You had a drop in commodity prices. So everything was, since then, has functionally said we're providing a lot more liquidity to the market. Unemployment, or the employment structure, has although, yes, it's weakened. This is a very interesting thing in a minute. It's still remarkably strong. So here's an interesting question. After the last employment number, the 12-month trailing average of job creation was still at 235,000 jobs.
Pretty high.
When was the last time that happened?
I'm going to say pre-COVID.
2015 for a short period,
Okay.
and before that 2000. So to add 235,000 jobs a month is an extraordinary rate of job creation in the absence of the fact that it's coming down from what were much, much higher levels. So the relative strength of the economy, because if you look at a 500,000 a year before, there's a slowing there. But our job creation rate is still extraordinary at a time when more or less maintaining the status quo of unemployment is give or take about 100,000 a month.
Let's just come back for a second to one thing that you had just said. So, and correct me if I'm wrong here, but I don't think the expectation was ever that the Fed was going to wait for inflation to get to 2% before they started cutting.
I don't think that they'd ever made any comment. They had a 2% target.
And they still do, as far as I know.
I don't believe that.
Why not?
Because I don't think they're going to get to 2%. And even if they do get close to it, the type of liquidity provisions that will already be in the pipeline are going to be raising the probability that they're not getting there. That's why, right? So if the Fed's now talking about 3 cuts next year, the market's got, I don't know, was it 6 or 7 over the next? If you're liquefying through the equity market, if you're liquefying through rate cuts, you're already lowering, number one, the price, or raising the probability that prices are not going to fall as fast. Number two, which is sort of he didn't want to talk about yesterday, I guess, we've had a lot of wage settlements in the private sector, but also in the COLA adjustments for retirees. By the way, I'm one now, so I'm going to be getting a lot more.
Congratulations.
But there was an 8.7% increase this year.
Big.
Every government employee, I believe, and many public, quasi-public people are also inflation adjusted. So those types of wage increases with inflation falling means there's a lot more potential upward pressure that can be consumption driven through a large part of the economy.
Yeah,
and
but you're not seeing, like, in general, though, like inflation adjusted earnings as a whole, ripping that much higher. I mean, it's now been positive for the last 6 months, but we're negative for 2 years.
Well, I'm not sure how negative they were. I guess, first of all, you had what might be negative in a direct payment, but you have to add in the type of money the government was giving to people in the alternative, and also, for example, which is on the other side now, but telling people they don't have to pay their mortgages. They didn't. I mean, there was a lot of
student loans,
structural issues that made relative income look far better, maybe than the straight measure of the payments themselves. And I think what you're going to find, I mean, we'll see, but I think it's going to be very hard for any business that's got unionized employees and the government itself, when it comes time to renegotiate, to sit there when their employees say that's what they got, we get the same thing, which means there's an enormous amount of risk that in fact we have much more wage inflation in the pipeline, or wage risk in the pipeline, than anyone wants to accept.
Not a whole lot of unions left, though, really, to drive that forward.
Well, there are 20 million government employees in this country.
They have a good bargaining power?
They still have pretty good. I've never seen a government employee fired. I've never seen them be asked to take a wage cut, et cetera.
Do you think, in hindsight now, just seeing what the markets have done yesterday afternoon, this morning, I think Fed Chairman Jay Powell says, ooh, that's not necessarily the message I wanted to give?
I think he knew exactly what he was doing. I mean, he had an opportunity to couch this slightly differently. As I said, I think to me, the single most important comment was the fact that if we're waiting till we get to 2%, we've waited too long. We see prices coming down. He didn't use the same statement he'd made 6 weeks ago. He should have said the market is now providing the type of liquidity we need. We don't need to do as much because of this, but he didn't do it. So I think embedded in this message for the moment is the risk that they've now accepted a higher level of inflation as part and parcel of their policy, which I, of course, think is a terrible outcome. But
a lot of people have been calling for that, though. Saying look, we've got a structurally different economy that maybe an inflation target more around 2.5% to 3% is more reasonable for the world that we're living in now.
Well,
does that not sound legit to you?
No.
Why not?
Because it has none of us have the privilege, from my perspective. Who set the Fed's mandate?
Congress.
What is the Fed's mandate?
To maintain price stability and maximum employment.
Right. And what is price stability? Zero inflation. So
is it?
It is by definition. Now, the fact is, the Fed was an unusual institution because it had a dual mandate, and it's actually there's a lurking third one about stable long-term bonds. But the bottom line is they have a two-factor optimization, which allowed them to functionally play with both. I think it was the Swedish central bank who motivated this move to 2%, but 2% is still not their theoretical mandate. And in fact, what was really sort of sad to me, they had inflation at about 1.25 to 1.5 and full employment about a decade and a half ago. And they said, well, that's no good. We don't like inflation below a level. And then all the modifications in how we define inflation and all these other measures. The answer is if it's not a good thing, the Fed should be going to Congress. And by the way, just to get off track, Lena Khan and the FTC to me are the same issue. She is a regulator and an administrator. She's not a legislator. She is trying to functionally change the definitions and the practices in the antitrust world. She should have gone to Congress. She's lost every case, basically, and it's costing American businesses hundreds of millions, if not tens of billions of dollars in business and legal costs. Shouldn't be for that. She should be in front of Congress saying, times have changed, things have changed. Please, we need to revisit this. And so my point to your question is, all of us, we can all decide what we want, but we live in, theoretically, and I think the Fed is telling you that doesn't make a difference, we live in a system where authority is granted from Congress to agencies to apply what they said, not to simply say, I don't really care what Congress said.
Right.
We'll do what we want.
All right. Neil, great stuff. Well, you could do this all day, right?
Oh, man. I feel like Neil and I could probably talk for the next 3 hours on this show, but we're going to have to keep it there for today. Thank you for joining us.
All right. Neil Grossman, he's a co-founder, former CIO of TKNG Capital, giving us some informed discussion of what we're seeing from the central banks. Again, we had the Fed yesterday quite dovish in their outlook. That's certainly the take from the markets. That's certainly the take, I guess, from the dot plot. ECB today a little bit less so.
And Bank of England, for sure, even less so from them.
Yeah, and I think what we heard from some voices this morning is that when you look at the UK economy, European economy, they're 6 months kind of behind us. So again, that kind of accounts for that. But we'll keep an eye on it. Markets are higher. This is Bloomberg. All right, Molly, let's do a little bit of a market check here. I mean, what are you looking at? Because I'm looking at the 10-year Treasury. We're kind of at the low for the day almost here.
I mean, I know we keep talking about this, but the fact that we were at 5% on the 10-year, what was it, like 6 weeks ago?
Yep.
And today we're below 4?
Yeah.
Wild.
Yes.
Like we just said, I mean, that's 100 basis points in cuts right there. That's
Exactly.
crazy. It's
right.
been a remarkable move. Treasury, obviously, mortgage rates, how much they've come down. It's a lot of easing.
All right, let's get a look at company news here with Lisa Mateo.
Good morning. Adobe gave a lukewarm outlook for sales in 2024, and that was a disappointment to investors who were expecting new generative AI tools to boost its results. Now, the company recently announced a new version of its AI model, Firefly. The company also revealed it's being investigated by the FTC. Bloomberg's Gina Cervetti has more on that.
Adobe says U.S. regulators are investigating the company's rules for canceling software subscriptions. The maker of Photoshop, Premiere, and other software programs says it is cooperating with the Federal Trade Commission and that a settlement could involve significant monetary costs or penalties. Adobe program users have long complained about the expense of canceling a subscription.
And Intel has announced new chips for PCs and data centers that it hopes will give a boost to the market for artificial intelligence hardware. Now, that lineup includes Xeon server chips, new Ultra-Core chips, and its Gaudi 3 AI accelerator. Now, Gaudi 3 is set to be released next year. Dell shares are higher right now. And Apple, that's also under close watch by the EU. We'll have more on that coming up in just a bit. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Connection lost.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, let's start off with yields. The benchmark 10-year Treasury 10 basis points lower. As you guys were talking before, 4%, not too long ago, 391 on the benchmark right now. This follows the latest data. America's labor market presses on. The weekly jobless claims dropping to 202,000. That is the lowest since October and close to a 5-decade low. At the same time, retail sales rose at the start of the holidays. So this all reinforces the idea that we can have a lower rate of inflation and not tank the U.S. economy. A soft landing. 8 of 13 sectors in retail posting gains. And the Fed pivot being embraced by investors after yesterday's dovish Fed meeting. The Dow Jones Industrial Average 70 points higher right now, adding to yesterday's record close. This is up 0.2%, 37,161. NASDAQ 100, that has now turned lower, 10 points lower right now. The Russell 2000 of small mid caps, that is up 2.5%. S&P 500, 11 points higher right now. That is up 0.2%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Molly and Paul.
John Tucker, thank you so much. We appreciate it. Molly Smith, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming as well on YouTube. So head over there and check us out. I'm just guessing all the strategists on Wall Street who kind of publish their 2024 outlooks, I got a feeling they're going this week and have to rewrite some of that stuff.
Got to notch them a lot higher.
They got to hit their targets. I don't know what you do from here. Young Yu Ma, he's the CIO at BMO Wealth Management. He joins us via Zoom here today. Young Yu, thank you so much for joining us here. Love to get your take in what we've seen in financial markets over the past couple of days, given some of the rhetoric coming out of the Federal Reserve.
Yeah, it's great to be here. Thanks, Paul and Molly. Yeah, a lot of excitement in the markets, no doubt about it. The Fed and Chairman Powell came out more dovish than expected and pulled forward some of what we thought was going to be some of those 2024 underpinnings and pulled those forward into a very late year market rally here, an extension of the rally. So we do think the elements are in place for a soft landing. We think that continues. We've been messaging that all year, but we don't think it's without risk. We don't think it's a time where the concerns about strained consumers that might crop up earlier in the year or other areas of the economy that might slow is to be dismissed. But we just don't think a slowdown will go very far. So we still think 2024 is shaping up to be a favorable year.
Connection
but
lost.
A lot of that enthusiasm, which we thought might take place in 2024, is taking place right now.
This is something I always struggle with, Young Yu, just for reference, this is my side hustle. My actual job is covering the economy. So when we're getting some of these reports, like the jobs report last week and the inflation data, now the retail sales this week, and I'm thinking like, man, this is all like pretty strong. And like, it's hard sometimes to distinguish, like, is this, obviously the inflation one aside, like, are these, signs of a soft landing, or is this, maybe like still too hot? How do you distinguish that?
Yeah, that's a great question. And it takes sort of a mosaic of looking at the data. And we do think that the jobs report or the initial unemployment claims that came out today, as was mentioned before, just in a tremendously comfortable spot to show that there's still a lot of underlying stability in the labor market. We do consider that a leading indicator and something that still looks quite healthy. Even though the labor market's coming more into balance, it's still something that is tilting on the healthy side. Now, when do things get too hot? I think it's a matter of looking at things such as wage growth. It's a matter of considering whether or not shocks to the economy are turning in a negative direction. Recently, those shocks, such as oil prices coming down, have been positive. So, there's some positive factors in play, but I don't think we're in danger of, in the near term, running too hot. I think even though we got a favorable retail sales reading, labor market that still looks healthy, I think when we look at consumer balance sheets, and spending ability across the spectrum of consumers, not just the sort of upper middle class and above consumers, we think there's some strain starting to show, which will become a bit more apparent earlier next year. So we don't think the prospect of running too hot is really on the table right now. To the extent that that's on the table, we think that's probably more of a end of 2024 story when the economy starts to reaccelerate. What factors are then coming into play in the labor market, in the global economy, in supply chains, you name it, that might add to stickier inflation. But right now, at least in the near term, it does look like that Goldilocks scenario continues to be on track.
So do we just run out and buy everything? What do we do here?
Yeah, well, we've already run up a lot, right?
Yep.
I mean, we have been advocating taking a relatively balanced approach to risk throughout the year and into 2024 as well. We think it's going to be in the marketplace a pretty even year in terms of where the gains are. We don't think it's going to be just concentrated in mega cap technology. We think value is going to do well, and particularly small cap value, which has had a big bounce in recent days as well. But we think that'll continue to hang in well and perform well in 2024. I think looking at areas of the market where valuations aren't too stretched and quality remains high is probably a good place to be, but also being cognizant of what the ongoing Fed messaging is. I mean, it's not obvious that the Fed is going to continue on such a dovish track and meet the market's expectations that are quite aggressive right now in terms of cutting rates. So I wouldn't recommend being overly aggressive just because the recent messaging change. We know that the Fed's messaging has changed quite a bit over the past year in terms of where, say, the year-end 2024 expectations are for interest rates. And the market's probably gotten a bit ahead of itself. So, it could be a bit of a modest environment as we move into 2024 if some of that slowdown materializes. But, we want to stay balanced here. It's not a time to load up on risk, we don't believe.
So if you didn't get in at the 10-year when it was around 5%, you think 3.9 is still a good entry point?
Not really. We think in the in the scenario where we do get a soft landing, we do get stabilization in the economy in the summer and maybe some reacceleration toward the end of the year, it seems unlikely to us that this sub 4% level for the 10-year yields can persist. We actually think they'll climb a bit from here. So I think short-term yields look relatively attractive. We've been recommending a balanced approach to duration, not being overly long duration. We actually extended duration when yields, the 10-year Treasury was right about at 5%. But since that time, we've been recommending a balanced approach to duration. And now is probably not a great time to get in. If you didn't get in, extend duration when yields were in the upper fours, now that they're sub 4, I think you'll see better times later in 2024 in the second half of the year. And staying short in the meantime, you get paid to stay short. right? You're clipping a bit higher yield and having that safety in the portfolio. So I think for a short-term approach, it'd be better to stay short, given how much those yields have declined.
On the equity side, how do you feel about valuation here? Again, a big run-up in the stock market this year, broadly defined. There is some earnings growth, kind of low double-digit earnings growth for next year. How do you feel about valuation?
I think valuation is okay if you strip out the Magnificent Seven. If you take out that area that's really AI driven and has a lot of future expectations priced into it, and you look at the median stock, it doesn't look nearly as extended for valuation, especially if you start looking at the value segments of mid cap and small cap value look actually quite reasonable, if not on the cheap side. So I think it depends. It's a mixed bag for valuation. And that's why I think we would advocate looking at areas for 2024 where valuation doesn't look as stretched, being sure you're not just loading up into growth and leaning into some of the value segments of the market as well.
What did you make of the Fed's projections yesterday? I was really taken back by that big upward revision to the 2023 growth estimate. In September, they saw 2.1% growth for the year, now 2.5. That's pretty big. Or 2.6? Yeah, 2.5 or 2.6?
It is big.
Yeah,
it's definitely big, and I think it's reflective of just some of the things that we're seeing concurrently happen in the economy, where we're getting numbers like we got today, retail sales being favorable. We've had lingering and ongoing strength in the economy throughout the year. Spending doesn't look exhausted by consumers and corporations. Although there's some belt tightening going on, it's not looking excessive. It's not battening down the hatches. It's more rationalizing spending. So, I think that makes sense to have that bumped up a bit. It's, a lot of that's in the rearview mirror happening right now. And really the bigger question, of course, is, how 2024 unfolds.
Yep. Young Yu Ma, thanks so much for joining us. Young Yu Ma is the CIO at BMO Wealth Management, joining us via Zoom. Molly, Alcaraz against somebody.
Nadal.
Did
you say somebody? Oh, Paul.
Netflix. Are you
killing me? Of course I'm gonna watch. March 3rd. Mark your calendar.
So Netflix is putting this on, right? This is
the Netflix slam.
Okay. So
haven't you heard of it?
I've kind of paid attention to it, but I'm a Netflix person, and so I want to see Nadal. I want to see how he looks after he's been away for a long time.
Yeah, a year.
And this is gonna be a huge test for him.
Yeah, obviously we're gonna see him before then when he's in action in Australia. So that's coming up in January. But yeah, I think this is a great, chance for him and Alcaraz. Obviously, it's got, fan viewership written all over this. It's going to be a palooza of viewers. So I think it's going to be great. And obviously, as Nadal being on the farewell tour, it makes sense to do some of these fun exhibition matches and give the fans what they want.
Where's it going to be? Do we know?
Vegas.
Oh, even better.
Yeah.
Even better. Another reason to go to Vegas. All right, let's head down to Washington, D.C. right now. Amy Marsh has got World National News for us.
All right, thank you, Paul. Getting word from New Jersey that evidently there's a bull on the loose in Newark running along the train tracks. First reports came in about an hour ago. Police say it's a bull still on the loose. New Jersey Transit says there are delays up to 45 minutes between Newark Penn Station and Penn Station, New York, because of the police activity. President Biden's struggles to connect his policy wins to voters' lives reflected now in the latest Bloomberg News Morning Consult poll of swing states. Bloomberg government's Jack Fitzpatrick tells us the president now trails former President Trump in all 7 of the battleground states that we're tracking for 2024.
Not only negative results, say, in the approval rating for President Biden, which have dragged for quite some time during his presidency, but he is trailing Donald Trump in each of the 7 key swing states: Arizona, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, and Wisconsin.
Bloomberg government's Jack Fitzpatrick reports the poll shows the president losing support among suburban women in Michigan, 18 to 34-year-olds, and union workers. House of Representatives has authorized the ongoing impeachment inquiry into President Biden. The measure passed on a straight party line vote. House Oversight Committee Chairman James Comer of Kentucky.
We're very pleased with the vote today. I think that sent a message loud and clear to the White House. We expect you to comply with our information requests and our subpoenas.
Democrat Jamie Raskin of Maryland says the attacks on the president are baseless.
It's got nothing to do with President Biden. They don't want the world to see that. They don't want the clarity of that disclosure and that understanding, because then they can't keep it going into the election season.
Raskin says the impeachment inquiry is purely about next year's election. And health officials in Gaza are warning Israel's attacks on Hamas may cause diseases to spread in the Gaza Strip. The Palestinian Health Ministry says vaccinations for children are dwindling and that running out of vaccines would be catastrophic. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The rally continues for stocks. Tech-heavy NASDAQ 100, though, the shedding earlier gains and weighing on the NASDAQ right now. Adobe falling over 5%. It signaled AI is going to take longer to give it a boost. The Dow adding to its record close. In its dovish meeting yesterday, the Fed teed up 75 basis points of rate cuts for next year in the summary of economic projections. And Neil Dudd at Renaissance Macro says the Fed pivot signals that there is more growth ahead.
This is about inflation coming in better and the Fed adjusting as a result. And that's ultimately a good thing. I think it's going to, give the economy a chance to continue growing.
Right now, shares of Moderna, they are 13% higher. Heavy volume there. News that it's a skin cancer drug that it developed with Merck, reducing the risk of relapse or death by 49% in melanoma patients. S&P 500, 15 points higher. That's up 0.3%, 47.21 on the index. The Dow Jones Industrial Average, 87 points higher. That's up 0.25%. That's at 37,177. The Nasdaq 100, 14 points lower. That is down about 0.1%. And yes, as Amy was reporting, there is a bull on the loose on the train tracks near Newark Penn Station.
Like a cow thing?
Yeah, it looks like it's. I see the
It
picture.
has
Somebody
horns.
on X posted a picture of it. It looks like a Texas Longhorn.
Wow.
So we'll
So far
say
from
that
home.
is metaphor for stocks, I guess.
There you go.
Wow.
I had to say.
How does a bull get on a train track in Newark, New Jersey?
Well, New
Not too many
Jersey's like,
ranches, not
you're
too
from
many
New
ranches.
Jersey.
Yes,
I mean,
and there are too many
we
ranches.
still have farmland, lots of it.
Remember
It is
your
the
roots,
Garden
Paul.
State.
Yep. Okay. All right.
So it's a bull.
There's a story there. Better
Big
not
deal.
interfere with my commute home. That's all I'm saying.
Yeah.
Take care of it.
I don't know about that. Anyway, that's your market update. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. Molly and Paul, good luck on the commute.
I'm Smith. Thank you very much, John Tucker, Molly Smith, Paul Sweeney. We're live here at our Bloomberg Interactive Broker Studio, streaming live as well on YouTube. So head over to youtube.com, search Bloomberg Radio. Max Abelson joins us, intrepid reporter, Bloomberg News. Also got a really cool TV show on Bloomberg Television and on all the social media. It airs tonight, Bloomberg Television, 10:30 p.m. Wall Street time. Lots of cool guests. This time, you got a name from my generation, John Corzine, the former New Jersey governor, ex-Goldman Sachs partner and chief. What's John Corzine up to these days, Max?
That's a good question, and it's good timing to have him on the Business Week show because our theme is second acts.
Second acts.
And this guy has had a second act and then another one after that, another one after that. Let's see if I can remember all of them. So obviously, he rose high up in Goldman Sachs. He took over the firm.
Yep.
Right as it was going public, he gets pushed out.
Yep.
So what does he do? He has a second act in politics. Not only is this guy a senator, but he becomes governor of your fine state, where bulls are running wild on the subway system. And then he goes on to take over what was then a lowly brokerage, and it was called MF Global.
Yep.
And he is in charge for its rise and then a very dramatic fall. I think
Unfortunate theme there.
Yep,
Yeah.
exactly right. When MF Global went bankrupt, I think it was one of the biggest bankruptcies, like not just in the financial services, I think ever in the United States. And, I think he had to pay $5 million in a settlement.
He personally did?
The CFTC accused him of having a role in the use of company funds. I think about $1 billion of them. And but he settled the allegations, didn't as one does, didn't admit or deny the guilt. Or the allegations, I should say. To me, he called it probably one of the greatest disappointments of my life, he said. But then he went on, and the true story of Wall Street is you rise, you fall, you rise again, you fall again. He went on to start a hedge fund, and that hedge fund he is just now closing down, and he's going to be managing his own money. And he said, look, it's hard to compete with like the big pools of money in an era of AI. So now at this late stage, he is also going to start again. And I'm just saying, I found it really fun to talk with someone who has been high and who has been low and is able to talk about both.
Yeah, absolutely. And then you also are having an international DJ on the show, talk about the different acts there. Tell us about that guest.
Yeah, I know. Well, we could have had a DJ and a Goldman Sachs CEO in one if we had David Solomon.
Missed opportunity.
That's
there.
right. If David Solomon is listening, I want him to know that DJ D-Sol would have checked two boxes for us. But we had John Corzine talking about his calamities and his successes on the one hand, and then we had Steve Aoki. And do you two know that name?
I do not.
Okay, well,
I don't either.
It really goes to show how generational gaps, how thick they are, because Steve Aoki is the kind of guy whose music has been streamed like a billion times, and literally a billion times. He is a dance music chart topper. He's famous for like kind of cake throwing, champagne spraying music sets at festivals, and yet this guy started as like a vegan hardcore punk. And he is now in this phase where he's trying to basically, I don't know how much you two know about longevity, but he's like basically interested in age reversal and trying to make this act of his life last as long as possible. We spoke about it.
All right, I'm going back to Corzine. That's in my wheelhouse.
You're allowed. Let's hear it.
What is he doing? He's 76 years old. What is he doing now? I mean, what's his plan? Or actually, let me start.
Sure.
How did he come on your radar? Because that's a name that I would not have thought of. I mean, he certainly had his up and downs, like you said, but he's kind of been out of the picture for a while. How did he come on your radar?
Yes. Well, I'll give you two answers to that. One is he has literally been in the news, but I think Bloomberg broke the news of closing of his hedge fund. So it's always an interesting time when someone's starting something or when someone's stopping something to interview them. But I gotta say, I'm getting old. I just had my 39th birthday. I've been reporting at Bloomberg now for like 13 years.
I hear you laughing back there, Lisa.
Yeah. But listen, I was at Bloomberg News as a young reporter when MF Global, I want to say I did a story, someone's going to have to check this on the terminal, but I think I did a story about Corzine hosting like a steak dinner, 48 hours before MF Global's collapse. And I've always been very interested in him as a figure. There are very few people who have effectively kind of transformed financial might into political influence the way he has. A lot of people want to. There are a lot of rich people who think that they can build impactful political careers, and they are often wrong.
Well, Gary Cohn, maybe.
Well, the partners at Goldman Sachs, right? I mean, Paulson, Cohn, and now Corzine, and now the current governor of New Jersey,
just
Murphy.
cranking them out.
Murphy.
Another.
That's right. I also wrote a profile of Murphy doing that. It's true. There's a precedent for it. And listen, don't forget John Whitehead.
Yep.
I believe he was in Reagan's administration. There's something about Goldman.
Yep.
They really understand how to have what I would call a second act.
So as John Corzine looks back on it all, how would he characterize his career?
It's so interesting. He said to me that between Wall Street and Washington, that human nature is fairly consistent, and that you're surrounded by these sort of like ambitious men and women who, are smart, and that sometimes they see opportunities for themselves, and sometimes they see other people in the way. And he said that over his career, looking back on it, he's been naive about that dynamic. Although it's like, how naive could he be, considering that he has managed to rise so high in both fields? But I recommend listening to it. I think you'll like it in particular. I hope that it'll be a rare chance to actually hear from someone who has managed to combine triumph and calamity, and not just one then the other or the second then the first. Like it's been a pattern in his life, and you could see it in his eyes and you can hear it in his voice.
Is he still sporting the beard?
Oh, sure. Still sporting a beard. So and a head of hair that kind of curls in the back. Very classic John Corzine look.
All right, very good. That's a great lineup there. A very eclectic lineup. Max Abelson joining us here. He's the reporter of Bloomberg News. He's got his television show here, Bloomberg Business Week.
The Business Week show.
The Business Week show. The Business Week show on Bloomberg Television, 10:30 p.m. tonight.
Eastern time.
Eastern time. And then all the digital platforms, I'm just guessing out there on Bloomberg.com and all the other kind of stuff. That's kind of how we do it. And that's how it's done now. Content. You got to distribute the content.
That YouTube internet thing that you love to talk about.
I like that thing. That's the internet. I think that's going to catch on someday. S&P 500, a little bit stronger here, up about 0.4%. The NASDAQ up about 0.3%. Again, we'll call out the Russell. That's kind of where we're seeing some movement here, up about 2.8%. Yields coming in heavy, folks. The 10-year Treasury is down 12 basis points, 3.89%. I'm getting ready to refinance the mortgage, maybe. Who knows?
Oh, yeah.
It's coming down. We'll see how that plays out. Lisa Mateo. She's going to be coming up in just moments. Let's get some company news with Lisa Mateo right now.
You got it. Results from a new study had showed a personalized vaccine developed by Moderna and Merck helped prevent the recurrence of severe skin cancer for 3 years. Moderna CEO Stéphane Bancel spoke earlier about it on Bloomberg.
Skin cancer is a scary thing, and what we are doing at Moderna is we're using our technology to develop individualized treatment where we make a different chemical drug for different patients. Everybody gets a different drug customized to the DNA of their cancer cell, and the data are striking.
Now, that data says that patients with severe melanomas who got the vaccine and Merck's cancer drug Keytruda were 49% less likely to die or have their cancer return than those who only use Keytruda. Now, Moderna shares right now, they're up about 13.5%. Merck is down just a fraction. And you can add Medifast to the list of companies, including weight loss, into their diet arsenals. Bloomberg's Joan Doniger has that story.
Dow Jones says Medifast usually used coaches and low-cal shakes and bars, but now it's investing $20 million in LifeMD. That's a telehealth company that provides access to doctors and nurse practitioners who can prescribe the drugs. And now it turns out Oprah is using them. She told People magazine she is taking weight loss medications as what she calls a maintenance tool. She didn't say which one. She's a board member of Weight Watchers.
Medifast is down nearly 2%. LifeMD is up about 2.5%. And CVS Health is among the 28 healthcare companies adopting AI safeguards from the Biden administration. The companies will commit to inform people whether they receive information that is generated by AI. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Markets continue to rally this morning. S&P 500 up 0.4%, 4726. The Nasdaq is up 0.3% as well. Again, the small cap stocks really setting the tone here. The Russell 2000 up 2.8% here. Yields coming in pretty aggressively here. The 10-year Treasury is down about 12 basis points. 3.89% on your 10-year Treasury bill.
What a rally.
So that is just extraordinary there. Let's call out WTI crude oil. It is up 3.9%, $72.17 there. Bitcoin off a little bit here, 42,600 on Bitcoin. Let's get down to Washington, D.C. right now. World and national news with Amy Mars.
Thank you, Paul. White House National Security Advisor Jake Sullivan is in Tel Aviv, meeting with Israeli officials as tensions between the U.S. and Israel have reached new highs. Israeli Prime Minister Benjamin Netanyahu pushed back against criticism of his country's war against Hamas, saying that they will continue fighting until Israel reaches victory. Russian President Vladimir Putin held his annual end-of-the-year news conference today. It is his first since he ordered the invasion of Ukraine nearly 2 years ago. Bloomberg's Greg Sullivan is monitoring from Warsaw.
We've heard about the war in Ukraine that came up early on, where he gave an unusual amount of detail, including the number of troops that are there. But what was significant there also was that he ruled out the need for a second mobilization, actually saying that a recruiting campaign the government is currently doing has pulled in enough troops, even saying more than they had initially planned.
Bloomberg's Greg Sullivan tells us Putin also addressed Russia's high inflation, nearly double the central bank's 4% target, and he says Russia is seeking a deal that suits both parties to release American prisoners, Evan Gershkovich and Paul Whelan. Donald Trump has pulled ahead of President Biden in must-win Michigan as voters remain pessimistic about the U.S. economy. The Bloomberg News Morning Consult poll shows Trump leads Biden 46% to 42% after they were tied in the same survey done in October and early November. House Republicans have threatened the Food and Drug Administration with a subpoena as they intensify scrutiny of the agency's efforts to deal with quality control for drugs made in India and China. Now, the letter from lawmakers cites a Bloomberg report that shows the FDA abruptly ended a program of unannounced inspections in India and reports of FDA efforts to undermine the Defense Department's bid to examine drug quality through independent testing. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg, Paul and Molly.
All right, Amy Mars, thank you so much. We appreciate it. One of the stories that we always like the big take stories here. These are really deeply reported, deep dive stories on really interesting topics. Today is on the economics of small U.S. colleges are faltering. This hits near and dear to my heart. There are a handful of telltale signs a school is facing stress. Rider University, I grew up right across the street from Rider University, a landmark in central New Jersey for the past 158 years, has been grappling with most of them. The school is losing money. Over the past decade, it has lost about a fifth of its student body, and this month, the outlook for its credit rating, already below investment grade, was cut to negative. So the economics of some of these smaller, particularly the liberal arts schools, really struggling. And I think it's a combination of, from what I've read, is demographics, fewer kids, the smaller population heading into college. And then maybe just as you and I were talking about, just the sense that, do I really need a college education and the potential student debt associated with that in this economy?
Yeah, the debt piece you cannot ignore, especially now that payments have resumed. And, for a lot of students who, probably have never paid student loans in their life until now. So this really is changing the dynamic. And also, not to mention, there are a lot of apprenticeship opportunities too, where you can just go straight into the workforce from high school. And especially if you're more interested in trade skilled work, where a lot of those shortages still are, there's a ton of demand for that right now.
It's interesting. Rider, again, I grew up locally to Rider. I know a lot of folks there. And Bloomberg, we have a Princeton office in Princeton, New Jersey. And we hire a lot of students from Rider, and a lot of the kids do great, perform very well, and have wonderful careers at Bloomberg down in our Princeton office. So interesting to see how this plays out. So there's definitely a connection there between Bloomberg and Rider over the years from our Princeton business. So again, it's the big take story. You can find it on the Bloomberg terminal, and you go Bloomberg.com/big take or NI/big take onto the Bloomberg terminal. Great stuff. We're gonna have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Abigail Doolittle. She'll give us a sense of what's happening in these markets. Lots of action, lots of volume out there as well. We're also going to sit down with Mickey Naftali, Chairman and CEO of Naftali Group, joins to discuss the risk he sees in commercial real estate. So we're going to ask Abigail to stick around and chat with us with Mr. Naftali. That should be interesting. Brian Van Cronkite, Portfolio Manager of Small and Mid-Cap Value Strategies at Allspring Global Investments. He's going to join us to discuss kind of what he sees in the marketplace. So all that's coming up. But first, let's kick things off with Mr. Charlie.
Hi, thank you very much. And here's what's going on. Paul Sweeney, the Dow, the S&P, NASDAQ continue to advance right now. S&P up another 19 on top of yesterday's blistering rally, with the S&P now at 4726. That is a gain of about 0.4%. Dow Industrials up another 104, higher by 0.3%, 37,197, trading in record territory on the Dow. We have got NASDAQ up 43. That is a gain right now of just about 0.4%. 10-year yield 3.90%. The 2-year 4.33%. Gold up $10.50 the ounce to $20.38, up 0.5%. And West Texas Intermediate crude surging 3.8%, $72.10 a barrel on West Texas Intermediate crude. A retreat for Bitcoin, down 0.9%, 42,613 right now on Bitcoin. So the Dow, the S&P, and NASDAQ all building on yesterday's gains. Equities are pushing higher. S&P 500 approaching its record. NASDAQ 100 hovering near that mark. Billionaire activist investor Nelson Peltz has nominated 2 directors to the board of the Walt Disney Company, including the media and entertainment giant's former chief financial officer. Shares of the Walt Disney Company, they are advancing now. We've got Disney up by 2%. Again, recapping, the rally continues on this Thursday. S&P up another 21, up by 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate it. Molly Smith, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. Abigail Doolittle joins us here in studio. She covers all the markets for Bloomberg. Abigail, some more action today. What are you seeing?
Yeah, there really is. What stands out to me the most right now, beyond yields plunging and stocks rallying once again, is the volume. On the S&P 500, what would you guess the volume is right now? So you've been watching. It's incredible.
It is.
I mean, but it makes sense because traders, after Fed Chair Jay Powell yesterday, did, to my mind, the unexpected. And I think that there's a lot of people out on the street who were very surprised by his, confirming the idea that they're going to cut, especially because less than 2 weeks ago, he was saying the opposite, that they're staying higher for longer. So it's almost like two personalities coming out of Powell, the surprise. The last time he did something like this, I believe it was 2018. If you recall, we had stocks plunging. Yields, though, bonds did front run it, similar to this time. This time we had stocks front run it too. But if you think that the Fed is making a major policy change, traders want all in. So the volume is 70% above on this S&P 500.
How rare is that?
So I don't know. Options expiry type type volumes. I mean, for an ordinary trading day, I honestly would be curious to go back in time and look at some of the other big Fed moves where it's
but it certainly is healthy for the move. I like to see more.
Oh, it's very healthy. Yeah, right. I mean, it suggests. So this is what's interesting. So the Nasdaq 100 has actually been flipping. It's been fluctuating between small gains and losses today, and a piece of that has to do with you have some of these big tech stocks down because there's a lot of talk of people moving out of technology, the Magnificent Seven, and into small caps and banks and a more diversified look. That equal weight, the equal weight S&P 500, up 1.6%.
Paul, you're all over it today.
I'm all right.
I should be interviewing you, Paul.
Keep going, Abigail. You're doing great.
So it's It's going to be interesting to see how this plays out, because if there is a rotation, it can only go on for so long, because that is the weighting to the market. You cannot have 30 to 50% of the market go down and the markets continue to go higher. But the fact that you have this kind of buying power beneath the surface is really pretty incredible. It tells you that traders are all in. Now, let's take this one step further. The NASDAQ 100 all-time high, but if you put that into a 5-year chart, it's essentially, it's not a double top, but it's essentially, it could actually be it could be a massive topping pattern. Now, is that, we don't know if it's likely or not. We just don't know if we're going to see the NASDAQ 100 continue to go up and away into a what would truly be a new bull market, or are we going to go back down into the range? We really don't know right now, but the NASDAQ 100 is leading the way.
Gotcha. So yeah, tech stocks really flying right now. Adobe though, not such a great day over
there.
No,
today's tech stocks really are not flying, because you have this rotation out of tech into the small caps. I mean, there are a couple that are flying, such as Broadcom and Tesla, if you consider Tesla to be a tech stock, which I think is a fair. But yeah, Adobe had some issues. They put up a decent quarter, but used those two magical letters, AI, and their revenue outlook, just not quite where folks wanted it to be. Plus, the stock into the report had been up 86%. So it was priced for perfection, and they didn't quite deliver that.
Can you stick around? Talk to
I
our
would
next
love
guest?
to.
Awesome,
Absolutely.
awesome. We want to get right to our next guest, because we want to talk commercial real estate, because I've got some big-time opinions. I know nothing about commercial real estate. I know nothing about it, but I have some opinions. Our next guest really does know stuff about that. Mickey Naftali joins us, CEO and chairman of Naftali Group. Mickey, thanks so much for joining us here in our studio. I'm a huge fan of New York City. I'm a huge fan of New York City real estate. But man, I'm hearing some dire stuff. People aren't coming back to the office. I'm looking down 3rd Avenue. I see lots of empty space there. What's your call on just, I don't know how you want to go with this, New York or just big cities, or how you're thinking about it?
Thank you for having me. So first of all, I don't believe in the office sector of real estate. So I invest mainly in the residential sector.
Okay, well, people got to live.
Yeah, yep. Exactly. Okay. So this is the thing. We really follow the demand.
So do you just go to Florida then?
Well, no, but let's talk about New York. So, in the past, I actually converted many office buildings to residential. And then there was the period of time of, great office buildings and even office buildings in neighborhoods such as at Chelsea and the Flatiron that were taken by the high-tech kind of companies and converting back to office. But my view of the office space is not great. And unless you have a truly Class A brand new office space.
Like this one?
Like this one, for example.
That you're sitting in.
With all the amenities that you have here, which is great, you're not doing well. The residential is a completely different story.
Let's talk about that residential. Right. So New York City, we were talking earlier, we both agree that it's not dead. But in 2020, there were a lot of people, including myself, where it felt, I was sharing with you, I loved how quiet it was. But you did what a lot of people said couldn't be done, which you essentially sold out a beautiful residential building on 79th and Madison, smack in 2020 into 2021. How did you do that? And talk to us about how what was behind that process.
So, going back to 2020, once COVID hit us at, around March, we started to hear on a daily basis, New York City is dead, New York City is dead.
Now, did you have butterflies in your stomach around that time just for a little bit, or were you?
Well, I was already in, and I had this project. I had a few projects. One of them was 3 years in the making. I bought multiple walk-up buildings on Madison Avenue, and I designed and I started to build the first high-end residential building anywhere between Park and Fifth Avenue in 25 years.
That's
right?
Incredible.
So think about it. For 25 years, the only option for anyone that wanted to live between Park and Fifth Avenue, and I would say high 60s to mid 80s, is either one of the co-op buildings. Some of them are very famous, but old, small windows, old elevators, old mechanical systems, and no amenities, right? So for 25 years, no one could really figure out how to build a new building. So anyway, we were already coming out with the superstructure on Madison Avenue between 79 and 80. And I was planning to open the sales office originally in April of 2020. Obviously, I said, oops, let's stop, right? Let's see what is going on.
Couple
right,
flies.
Exactly. But then when the superstructure, we kind of stopped for about 2 weeks, construction in New York, and then we continue, and we coming up with the ground, and the superstructure was almost stopping off, and we started to get phone calls from brokers and direct from buyers calling our office. Now, we didn't have any sign on the site except our name, our company name. So people Google whatever, and they found our phone number, and they called us. So I said, oh, very interesting. So there is a demand. People are really, they're really curious. They want to buy. So September of 2020, I decided to open the sales office. The space was ready to open. I didn't open it, right? September 2020, I opened the sales office. And between September and December of 2020, I sold out.
That's amazing. That's just incredible, because having been here, the city really was.
The demand is here in good days and bad days. Of course, there is a slowdown. Of course, by the end of the day, if you have, by the way, not only real estate, if you have a product that is there is a real demand for it, you're going to do well. It's all about inventory and demand, right? So there was zero inventory, and there was a demand, right? So that's why we were, I mean, that was the first of 3 projects that since then sold out. Sold out on the Upper East Side. All of them were doing extremely well.
And they're, I mean, I'm now here in Sutton Place, but I had been on Upper East Side, and I saw day by day the one on 83rd go up. I mean, just absolutely very distinct. And I think it's at the limestone, but the amenities, yeah, it's really pretty incredible.
So I want to ask you, you know, selfishly, I just put in a down payment for very exciting. I just put in a down payment for an apartment on 67th and 3rd, so in Lenox Hill.
Congratulations.
Thank you. But of course, I want to hear, you know, if you think the value of it's going to go up. But it's, you know, it's a but you know, you've been talking about these luxury buildings, all the amenities. Is there still value though for some of these buildings that are a bit simpler? You know, maybe just like good location, doorman, elevator, laundry in unit, amazing, and a terrace. But like maybe you don't have the big gym and all these other amazing common spaces.
So I would say I don't know if the value will go up, because think about where we are in all luxury product. The way we live today, most of us, right, compared to our parents or definitely our grandparents, different quality, right? The huge different, right? So there is a demand for quality. Also, most of us are much busier than our parents and definitely grandparents. So we are looking for every moment that we have. We're looking for the lifestyle that everything will be very accessible and close to us. Amenities are very important. It's part of the lifestyle that we all, or not all, most of us that can afford are looking for. So I would tell you that there is no question in my mind that the appreciation of value is much higher for a really, really good product, and not as much for let's call it an older product. Having said that, location is as always very important. So if you're in the right location and you have the right bones and you upgrade your unit, you will do well.
I like to hear that.
How would you describe South Florida right now? Because we had the story here, as you well know. Seems like everybody in New York City left for Miami, South Florida in general. Give us your extent. Is it too much, too fast down there, or can this market really, I guess, thrive?
So it's actually very interesting. I have 2 what I call mega projects in South Florida. I'm building a 70-story, 1.5 million square feet in Miami, in downtown Miami, in a neighborhood in Miami World Center, which is a new neighborhood in downtown Miami. And I'm building a very similar size twin 50-story towers in Fort Lauderdale in Flagler Village. So
bullish, I'm guessing.
Miami and Fort Lauderdale are different, but here is the thing. For us, okay, it's all about demand. We think that we are quite good in designing and creating a really good product, but we're not good enough to create a demand. So we really follow the demand. We look at where the demand is, and that's where we go. Specifically about Miami. Miami matured to a point, in my opinion, of no return.
Yep.
Miami can offer not everything that you can get in New York City, but almost everything between culture and restaurants and you name it, and sports, and everything is there. And of course, many months of the year, beautiful weather and the beaches and all of that, right? So, you know, for us, this is a really important market, and also a market that attracts quite a lot of Latin American buyers that either want to park money in the U.S. or as investment, or they just use their apartments X amount of weeks, a year. So I think it's a strong market. I just opened a sales office for the Miami project 4 weeks ago.
Okay.
We are doing well, so we think it's a strong market.
Yeah.
And that there's still more upside to it?
Yes, because here's the thing. Remember, we are still in an environment, or we are in an environment of high mortgage rates, right? So
Just dropped below 7% today, but yeah, keep going.
correct.
Yes.
No, correct.
Yeah.
So going forward, thinking about going 24, 25, we believe, and I'm sure that you believe, that mortgage rate will start to go down. There are still buyers that sitting on the fence and waiting, right? And waiting. Now, long-term projects that are going to be complete in 3-4 years, anyway, they don't need to commit to take mortgages right now. So it's all about deposit and taking a position in a market that eventually there will be appreciation in price.
You know, on this topic, just yesterday, the Fed indicated that they are going to be lowering rates next year. So it supports everything that you're talking about in terms of being below 7%, the idea that rates will go lower. Is there a point where the housing market could overheat too much? Because I grew up in upstate, and my family member yesterday was just sharing a picture of I think a 1,500 square foot house going for $1.1 million. That same house 5, 10, 20 years ago literally would have been $150,000.
Right.
And so I'm just thinking, if more fires put onto the market, it may be good, it will be good for somebody like you for a while, but at some point, is that going to create issues?
So it's all
overheating?
about supply, it's all about inventory, right? And in the main in the main cities, there is, by and large, there is lack of supply.
Right.
Now think about it. It's not only the mortgage rates. There are only few developers that can build today. We were either lucky enough or qualified enough to close.
No, it's just running out of time. We'll get you back next time in New York. Sounds like you're in New York a lot, so we'll get you back. Or we'll go down to South Florida. Mickey Naftali, CEO and Chairman of the Naftali Group. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Sources tell Bloomberg that Credit Suisse dismissed its entire wealth management team in China, scrapping its ambition to become one of the biggest foreign money managers in the country. Now, this as UBS Group decided not to take on the staff. Bloomberg's Nick Comfort says it's surprising.
For UBS, Asia and wealth are big areas of focus. These are key driving areas. It's a business that they love. However, I think it does show, speaking to that complexity of that transaction of incorporating Credit Suisse, that they aren't willing to hold on to all the business. They are, if it's too complex, if it's too risky, then UBS does not want to carry it forward.
Now, those let go are said to include relationship managers and investment consultants, as well as the CEO of Credit Suisse's securities venture. UBS right now is up about 4%. And more fallout involving a unit of General Motors. We get more from Bloomberg's Joan Doniger.
Dow Jones says Medifast usually used coaches and locale shakes and bars, but now it's investing $20 million in LifeMD. That's a telehealth company that provides access to doctors and nurse practitioners who can prescribe the drugs. And now it turns out Oprah is using them. She told People magazine she is taking weight loss medications as what she calls a maintenance tool. She didn't say which one. She's a board member of Weight Watchers.
And Wayfair workers, they're being told to expect longer work hours. In an email to employees seen by Business Insider, CEO Niraj Shah said the company is back to being profitable, but winning takes hard work. Now they should expect to put in more hours and find ways to blend work and life. Wayfair right now is up nearly 13%. Those are the company stories we're following. I'm Lisa Mateo. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. Stocks near all-time highs after the Fed's dovish tilt. The Dow, the S&P, NASDAQ are all surging right now, but perhaps the biggest story, the Russell 2000 index of small-cap shares. That index up now by 2.9%. David Sowerby is portfolio manager at Ancora Advisors, and on surveillance this morning, he told us there is no question investors are embracing risks, specifically with small caps.
Anecdotally, I am seeing with more of the investment committees I work with that there's a greater discussion of do I up my small cap allocation? Do I think about a something other than a cap weighted passive S&P approach? And that anecdotal is starting to play into the markets where you're seeing marginally people increasing their small cap allocation.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Again, the Russell 2000 now higher by 2.9%. To put that in context, S&P up 0.5, up another 25 points. The Dow also at a record up 170 points, up 0.5%. The NASDAQ Composite Index up 66 now, a gain there of 0.5%. 10-year yield 3.88%, but the 2-year that's yielding 4.32%. Spot gold up $10 the ounce to $2,037, up 0.5%. And West Texas Intermediate crude surging 4%, back again with the 72 handle, 72.22 for a barrel of WTI. Briefly, retail sales unexpectedly picked up in November as lower gasoline prices allowed consumers to spend more to kick off the holiday shopping season. Among selected retailers, we got Macy's up 1.8%, Target shares up now by 2.5%, Kohl's is surging by 7%, Amazon down by 0.5%. Recapping, S&P up 25, up 0.5%, 10-year 3.88%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. Molly Smith and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, and we are also now in your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, the good news is it is free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it is all presented by our sponsor, Interactive Brokers, so we thank them. All right, we're seeing signs here that this rally, that for the most part this year was pretty limited to a handful of names, is kind of broadening out a little bit. We see it in the Russell 2000 and some other indexes as well. I want to see if that has some legs to it. Bryant Van Conkrite joins as a portfolio manager, senior global equity at Allspring Global Advisors. Yes, Allspring Global Advisors, home of my favorite investor, Ann Maletti. We'll take Bryant, though. Hey, Bryant, thanks so much for joining us here. What do you make of the price action we've seen over the past couple of days? I guess the Fed got its message through, if that's in fact what they wanted to communicate, that we're going to be maybe a little bit pivot here.
Well, it's great to be with you. And first of all, Ann passes along her best wishes to you. You're right. I think the Fed's message was a critical one. What they're basically signaling is that they're willing to restart the next cycle before the current one ends, which is very unusual. The Fed is usually reacting to data, reacting to news. And for the first time that I can recall, they're significantly trying to be proactive, right? So we haven't seen the recession in a material way, but they're going to go ahead and kickstart the economy by lowering rates, if they do indeed do that. What do you want to do as an investor? Well, you want to do what the market's doing. You want to embrace risk. If that's the case, what typically works as the Fed indicates they're going to stimulate and move us forward and move the next cycle, you want to buy risk, you want to go down cap, you want to go into value over growth, and you want to diversify into a broader swath of the economy. And if you look up at the S&P 500, which is lagging today, or you look at the Russell 1000 growth, those are very concentrated indices in a handful of names, and that's not what you want right now. And investors are voting with their money today and buying risk, which is the right thing to do in the short term if the Fed is truly going to do what they say they're going to do.
Now, Brian, tell us about your outlook for the timing of cuts, because it seems like you are forecasting them to be a bit later than what the markets expect, and that could really disappoint a lot of people who are parking their money on betting on those early cuts.
For the better part of 2 years, the market has been habitually early in expecting cuts from the Fed, and we've always had to kind of keep pushing that to the right. And this is the first time the Fed has, in my opinion, given us clear evidence that they actually are thinking about cutting rates. Now, I still stay in the camp that they're going to be longer and later in doing so than what the market's pricing in. I think we're going to have to wait for them to actually see evidence that inflation truly is going in the right direction. Now, the only exception to that, which might be the way this plays out, and the reason the Fed might be right and the market might be right, is that we have poor data coming through. The consumer looks to me to be weakening, although in an okay place today, definitely weakening.
I was going to say, did you see the retail sales data this morning?
Yeah, I did see
Pretty
that.
good.
Pretty good so far, but if you look at spending in general, it's starting to weaken. You're seeing